Good morning to our wonderful audience and welcome to the Fundrock Global Investment Conference. Over the next 2 days, we will navigate the realities of a shifting macroeconomic landscape, from stabilization or not of global inflation rates to the massive capital reallocation driving markets and sectors. Our focus centers on resilience, diversification, and how the development of next generation artificial intelligence can potentially impact on portfolio construction. On screen now is the agenda for the day, and we are joined by some of the industry's leading asset allocators and strategists to dissect volatile markets and uncover alpha in known places and perhaps some unexpected places as well. Among some of these exciting topics that we will look at today is emerging markets, AI winners, why quality works over time, man plus machine, and the last one, I think very topical, investing in a future no one can predict, of course. Time allowing, we will cover questions received in the Q&A box as far as possible. We also invited some of the top DFMs as moderators to these sessions, and we want to thank all these moderators in advance for all the time you took in preparing for your panels. And a big thank you, obviously, to all our presenters across the globe for bringing your expertise and vision to this prestigious conference. With that said, let's begin our first session on emerging markets. And as moderator to the session, we are joined by Samir Singh from Glacier. Good morning, Samir. How are you doing?
Good morning, Eugene. I'm well, thank you. How are you?
Good, thank you. Samir, thank you so much for joining us. And like I mentioned, for preparing for these sessions, we know it's very time-consuming and a very interesting topic indeed. Samir is joined by Lars Hachenbach, Executive Director from Rescura. And also in the call, we've got Ian Barnes, all the way from the UK, representing Sands Capital. And both of them will take some questions after the presentations. Samir, with that, I will hand over to you. Thank you so much.
Good morning, everyone. And thank you, Eugene, and the team at Fundrock. So this morning, we're talking emerging market views and opportunities in this session, and for good reason. After a prolonged period of underperformance, we've seen a meaningful shift in 2025, with emerging market assets delivering strong returns, and in many cases, outperforming developed markets. What makes this cycle particularly interesting is that the opportunity is no longer just about growth. It's about selectivity and implementation. Emerging markets today are being shaped by a combination of stronger fundamentals, shifting global capital flows, a weaker US dollar, and structural trends like AI, supply chain reconfiguration, and domestic growth stories across regions. At the same time, the risks still remain very real, whether it's geopolitical uncertainty, currency volatility, or the increasing concentration of returns in specific sectors and countries. So I think the question for investors is no longer simply whether to allocate to emerging markets, but how to do so effectively. And that's where today's discussion becomes particularly relevant. On the one hand, a single manager approach offers high conviction access to the best ideas, with returns driven by deep fundamental insight and stock selection. On the other hand, a multi-manager approach seeks to navigate the complexity of emerging markets by diversifying manager risk, balancing exposures, and actively managing the overall portfolio. So what we want to explore in this session is how these approaches differ, where each adds the most value, and ultimately, how allocators should think about incorporating emerging markets into their portfolios, both now and looking ahead. And with that, I'll hand over to Lars from Rescura to take us through the multi-manager approach. Thanks, Lars.
Thanks, Samir, and good morning, everybody. I'm going to deviate a little bit actually from the assigned topic about opportunities in emerging markets, because I suspect that through the next 2 days, you guys are going to hear quite a lot about opportunities and what's coming on the horizon and all a lot of great stories. But instead, to just catch on a couple of words that actually Eugene also used in his introduction, which is it's often overlooked the risk management side of portfolio construction, and particularly actually in emerging markets, the risk management is really quite an important part of how a portfolio is put together. and what the ultimate results will be, and really what it is that investors are looking for in that sense. And so you just share my screen. There we go. So what I'm going to do is really take us through a little bit of the investment risk and what I'm going to call market structure risks that we face in emerging markets, which are actually quite different to what we see in developed markets or perhaps in the South African market uniquely. So traditionally, there are a number of risk drivers, and actually, Samir, you've even described one or two of these already. When you're looking at emerging markets, they're sensitive to global risk sentiment. They're very sensitive to capital flows. The dollar is known to be inversely related to emerging market returns. So a weaker dollar typically means that money flows into emerging markets. That causes asset prices to rise, and vice versa. When US interest rates rise, then investors, global allocators, they tend to withdraw their money from emerging markets so as to earn slightly higher returns back at home. So these are kind of familiar investment risks, and there are lots of papers and thoughts about how exactly to manage those. And for sure, over the last couple of years, I mean, this is a 5-year chart, we've had our share of crises, some positive, some negative. We've had the war in Ukraine, we've had the war in Gaza, we've had Liberation Day in the US, we've had the Iran war most recently, but also a couple of sort of, let's call them positive surprises. The launch of ChatGPT back in the day, in 2022, we all didn't really pay too much attention. Nowadays, of course, it's everything. The launch of DeepSeek, the Chinese competitor or equivalent to ChatGPT, which was a big deal for the developed markets, actually, because it showed that emerging markets were capable of delivering technology that was on a par, and in many cases, in this case, much cheaper than in developed markets. And so we've had our share of crises, and it certainly means that if we look at the performance of developed versus emerging markets over the last five or so years, certainly the total return has been better from developed markets. But if you look at the breakdown by year, then you'll see that there was a very strong inflection point. The first couple of years, developed markets strongly outperformed, even in those times where there was a negative return, and they did less negatively. But there has been a very significant shift in the last 18 months or so when emerging markets have strongly rebounded. And if investors were underallocated to EM in that window, then their total return would have suffered quite materially. And correlation between the developed and emerging markets is now showing at about 0.37, so a very useful diversifier. And in fact, if we look at a chart of correlation over time, then we'll see that the current correlation between developed markets and sort of the South African market, developed markets, and some of the other main emerging markets, the correlation is currently at a historical low when looking at over sort of a 20-year horizon. Now, what I did say at the beginning is rather than sort of look at this at the very high level risk management, I wanted to focus in on something which I've called the market structure issue in emerging markets. And the problem really is these guys. 3 emerging market companies, TSMC or Taiwan Semiconductor Manufacturing, SK Hynix, Samsung. TSMC is listed in Taiwan. SK Hynix and Samsung are respectively listed in South Korea. Now, all 3 of these companies have been major beneficiaries of the AI boom, and certainly over the last year or so, that's really come through very strongly for them. You can see the total returns that these companies have earned over this period. 400% or more return out of TSMC. Samsung 200%. SK Hynix, almost feels like a laggard with 65% return over 2 years. Of course, most people will be extremely jealous if their stocks performed in that way. And all 3 of them are now part of the exclusive $1 trillion market cap club globally. They, in fact, are the 3 of the 4 global emerging market companies whose valuation exceeds $1 trillion. The only other one is Saudi Aramco, the large Saudi Arabian petroleum company. But these guys basically, if we were rewind the clock by a year, they would not have been anywhere near that market valuation, and yet here they are. And so obviously it's great if you're an investor in these companies. Each of them would have given you a very, very successful return. But what it's meant is that their total weight in the emerging market index has significantly increased. So at the start of 2024, there were about 10, maybe 12% of the total index. Now it's closer to 20, 21%. So their percentage in the index has almost doubled. And in fact, just these three companies in the emerging market index, they make up about the same proportion of the EM index as the Magnificent Seven, the technology companies in the US, make up of the MSCI World, the developed market index. So we have a similar phenomenon in that a small number of technology companies making up let's call it a quarter, just to be round numbers, of the index. But in the EM's case, there's only three companies who are doing that, whereas on the developed market case, it's more like seven companies. And in fact, Taiwan Semiconductor on its own represents 13% of the EM index. So it's a very, very strong domination. And that, of course, carries through into the country weights as well. So TSMC is by far the biggest company in Taiwan. South Korea, like I said, is SK Hynix and Samsung. And so the country weight of Taiwan and South Korea has significantly increased in the emerging markets index. Now, of course, both of these companies, either at an individual stock level or at a country level, it means that from a risk management point of view, what might appear to be an underweight to a single stock quickly translates into an underweight into a country or indeed into an entire region, Southeast Asia. And so these three companies have a very, very outsized impact on the behavior of the emerging markets index overall. It's very similar actually to what happened to Naspers on the South African market some years ago, when it became such a large component of the index that its performance really starts to dominate what happens in an entire country. Now, this is all fine and well. Like I said, if you're a shareholder of these companies, you'd have done very well. You'd have been very happy. But if you as an asset manager or as a client of an asset manager discover that you are in fact underweight in one of these counters that does very, very well, then of course you are liable to suffer some quite significant performance drag. So what I've gone and done is to look back over time, same 2-year window, what has been the average emerging market manager weight to these three companies and to the cumulative exposure to these three companies. And it turns out that, other than Samsung, which has kind of been close to benchmark weight in most managers' portfolios, the other two, TSMC, has actually been quite strongly underweight in managers' portfolios. Now, that is the average manager portfolio. Undoubtedly, there are going to be a few really clever guys out there who have gotten an overweight position. They've done very well. So I'm talking about the average manager here. Average manager has been significantly underweight TSMC, has also been significantly underweight SK Hynix. And as a result, the cumulative underweight to these three counters has been quite material. It's been almost 5% in aggregate. And because of the very strong returns, you can see in the little box on the bottom left-hand corner, the performance impact of having these misweights in the portfolio has actually been a loss, an underweight, an underperformance, of more than 10% over this 2-year period by the average manager in emerging markets. So it's a very, very significant underweight that's being and underperformance that's being created by having this underweight position to just two companies in the total index. And you might have good reason. You've done your research, you think the valuation is too high. You've got good fundamental grounds for holding that position, and yet you got it wrong. The performance impact has been very, very, very significant. So this type of underperformance is part and parcel of the life of investing in emerging markets, right? This is a box plot of emerging market manager returns, most recent on the left on an annual basis, and then working across towards the right-hand side. And it's basically showing us the index in the middle, that's the sort of the yellow square, and then showing the quartiles of the emerging markets manager universe. Top quartile being the top of the dark blue, and the fourth quartile being the bottom of the dark blue. I want to draw your attention to the scale of these numbers, right? So you're always going to see some deviation between the best and the worst, but here the deviation in emerging markets could be as much as 20%. 20%, not 20 basis points, 20%. So getting the right manager in your portfolio is absolutely critical when you're talking about an emerging markets portfolio. Or alternatively, as I would perhaps argue, having a multi-manager approach. So you're not unduly reliant on picking the absolute winner in the space, but rather to say, yeah, I'm going to put my money with several managers, maybe regional specialists or country specialists, and then get something which is a little bit closer to the index, but I'm not going to have anything like this type of volatility, this type of spread of potential outcomes. So trying to maximize your investment outcome, you want to get the best out of your fund manager, but avoid the blind spots. And so basically in emerging markets, much more than anywhere else, risk management is absolutely essential. How can you achieve that risk management? What kind of things can you do to get yourself away from this sort of benchmark and portfolio risk? Well, you could use passive ETFs or futures to, say, top up individual positions. You could use single stock exposure if that's available to you. You could actually transact and own some of these underweights yourself, and you could sort of top up some of that weight. And then kind of let the alpha come through from some of the other stocks in the portfolio, as opposed to being unduly buffeted by one or two very, very large companies. And just as a worked example, I mean, we in our multi-manager portfolio, we do use both ETFs and single stock positions to try and mitigate some of that risk. Here's a snapshot of our portfolio. Once after we've done this kind of, let's call it intervention. Whereas if we hadn't done the intervention, then our weights would have been closer to this. And I draw your attention to the weights, particularly of Taiwan. You would have been, almost 7% less in Taiwan if we had just let our underlying managers' positions shine through, as opposed to saying, look, that level of underweight is not comfortable. We're going to do something about that. We're going to intervene. And as a result, the performance that you're going to get from a multi-manager approach is going to be much closer to the index overall. It's much more of a steady Eddie situation than it is being this dude over here who, is basically hoping that there's an Armco barrier on the side of the road because, quite honestly, they haven't really counted and allowed for all of the risks that their portfolio is facing. And there we go. Thank you. Samir, back to you, and we'll have some questions after.
Lars, very interesting indeed. Before I hand back to Samir, we're going to air a quick update from Brian Christensen of Sands Capital. And just a reminder, Ian Barnes is from Sands Capital, is in the part of the panelists. So if you want to direct questions to either Lars or Ian, you're more than welcome to do so. Dan, we're ready for you. Thank you.
Hi, my name is Brian Christensen, and I'm a co-PM on both our emerging market strategy at Sands Capital, as well as a co-PM on our global growth strategy at Sands. Both strategies are available as feeder funds on the BCI platform. Today, we're here to talk about the emerging market strategy. We want to talk a bit about how the opportunity set has evolved from the previous decade and why we think that's going to look different over the next decade, and dive a little bit deeper into the AI opportunity set that we're in the midst of a technological revolution, which is creating significant opportunities for emerging markets investors. First, a little bit of context on Sands as a reminder. At Sands Capital, we really do one thing. We invest in leading innovative growth businesses all around the world. We express that in a wide variety of vehicles, both on the private side with venture, mid, and late stage growth equity strategies, as well as on the public side, investing in US, global, international, and emerging markets strategies. But one thing that all of our strategies have in common is that we deploy the same investment philosophy and criteria. We're concentrated, we're conviction weighted, we're growth oriented, and we have a very long term time horizon when we're thinking about investing in some of the most innovative, differentiated growth franchises around the world. Here with the emerging market strategy, you can see that investment philosophy and criteria in these statistics that we see in front of us. So at any given time, we are typically invested in between 35 and 45 businesses. We are conviction weighted with a significant exposure to our best ideas. Our average turnover has been about 23%, which is consistent with a 5-year type of investment time horizon. And we're very much growth investors. Last year, we estimate our growth portfolio did about 25% earnings growth in our emerging market strategy, which is roughly similar to the type of growth that we're projecting on a go-forward basis. Here's a graphical illustration of our concentrated portfolio of emerging markets businesses around the world. A few things that you'll notice. The first thing you'll notice is a heavy concentration in the big four emerging Asia countries. That's not only because of the large population sizes, the fast growing GDP growth, but they're also at the center of a technological revolution that's happening both in AI and is also driving middle class expansion and strong secular tailwinds across these regions. So more specifically, we have approximately 80% of our portfolio invested across China, Korea, Taiwan, the three largest of the four countries in terms of portfolio exposure for us, but also in India. We also find meaningful opportunities outside of those four countries, but we call that primarily rifle shooting, where we're finding a handful of countries or companies and countries across Latin America, CEMEA, as well as ASEAN. What we've seen over the last several years has significantly evolved the emerging markets opportunity set. And that really got kicked off with the launch of ChatGPT, which, if you recall, that was in early 2022. We've had a number of innovations as it's related to AI, including model architecture, hyperscaling cloud compute, coding and developing tools, and more recently, agentic AI, which actually allows AI to do real work for individuals. And each of those things have happened in a very short amount of time, which has created a very significant opportunity for companies that sit at the choke points of enabling AI across supply chains in AI infrastructure. So many of you have obviously heard of companies like NVIDIA in the US, which is the dominant leader in GPUs. You're likely familiar with OpenAI and Anthropic. And you've probably even heard of TSMC, which is the dominant leader in outsourced semiconductor manufacturing. But perhaps less of you have heard of companies like SK Hynix or MediaTek or Nora and Chroma, Delta and Hyosung, Montage. And what we're trying to illustrate here is a broad sense of diversification of companies that we believe are sitting at very important parts of the AI supply chain. That's across design and fabrication of both training and inference chips, very important component technology choke points with memory, with SK Hynix being the global leader in high bandwidth memory, which is not only required for traditional chat-based conversational large language model conversations, but also we estimate that high bandwidth memory is required at 10 to 20 times the intensity for agentic workflows, which we think is going to be a very large tailwind for companies like SK Hynix, as well as Samsung, and then Micron in the US. And those three companies are essentially the oligopoly that exists today in high bandwidth memory. On the right side, you see companies like AMEC and Nora. What's fascinating about those two companies is that China is really trying to create a domestic substitution opportunity for critical parts of the semi-cap equipment supply chain, both because of national security reasons, but also because of fears of potentially being eventually choked off from the US or allied market, Western market supply chains for AI. And these are two companies, domestic companies in China, that are the leading innovators for creating the semi-cap equipment that the chip manufacturers require. In long term, China set a goal that the majority of their semi-cap equipment will be purchased from domestic companies. Outside of chip building, we see significant opportunities in data center infrastructure. Power is a very critical part of infrastructure. Delta is a company that, for example, makes power voltage electronics. Not only is access to power important for the data center, but controlling the voltage. GPU racks are extremely sensitive to changes in power voltage, which Delta helps control. Hyosung is a Korean company which makes power equipment. Getting power to the data center today, there's multi-year backlogs for electric transformers, for example. And Korea, due to its significant industrial base, has been able to gain market share in very critical power-related areas, including even nuclear, for example, in this global market that's undersupplied for important power equipment. Those are just a handful of the types of opportunities that we're seeing. But as you see, or as you can imagine, we're seeing supply chain opportunities related to AI, not only in Taiwan, not only in Korea, but also in China. In any paradigm shift, phase one that we've observed historically is a huge opportunity for the infrastructure layer. But over time, we also think there's a significant opportunity in the application layer. And we have a number of businesses that we think long-term are also going to benefit by harnessing AI into their existing products, services, and workflows. And we believe, many of our internet-related businesses, whether that's an Alibaba, Tencent, or Mercado Libre, our financial services companies that are deploying an AI-first tech stack, for example, like a Bajaj Finance, or a company like Xiaomi in China, which is one of the leading smartphone providers. They've also expanded into the EV market quite successfully. And then they build out smart home equipment. Think smart air conditioners, thermostats, refrigerators, washer dryers, and being able to use edge AI and large language models to better control the entire consumer ecosystem for their customers that live in the Xiaomi ecosystem of products. We think there's going to be even more opportunities as we go forward with the successful adoption of AI across product categories. So this shows how our positioning has evolved from 2023, which is shortly after the launch of ChatGPT in 2022, as I mentioned, through the end of the first quarter in 2026. So you see a significant both diversification and increase in the overall exposure that we have in the broader AI infrastructure opportunity. We're meaningfully overweight. We think we're in the early innings. To give you a sense of the magnitude of spend, last year in 2025, the large US hyperscalers, so think Google, Facebook, Meta, Amazon, Microsoft, they spent approximately $350 billion in AI-related CapEx. Those same companies are on path to do over $700 billion this year, so a roughly 2x year over year in 2026. And it's estimated that they're likely to spend over $1 trillion in 2027. At these dollar amounts, that is spending that exceeds the Manhattan Project in the US decades ago. So this is one of the most important technological revolutions that we've seen in modern history. A meaningful part of that CapEx is going to companies like NVIDIA or Broadcom, for example, for chips. But a very large part of that CapEx is going to the emerging Asia supply chain. And we wanted to be diversified, have meaningful exposure across a variety of different choke points, which we think is creating significant opportunity for emerging markets investors. That's also led to a quite significant shift in our geographic allocation over the last several years. Now that there's a domestic supply chain in AI, you've seen our China weight modestly increase. Our Taiwanese weight has gone up significantly. We're very long-term shareholders in TSMC, but now we have, a number of small to mid-cap businesses, which we think are benefiting from the AI infrastructure boom. We own both SK Hynix and Samsung, which I mentioned earlier, are critical players in the memory bottleneck for enabling not only AI, but agentic AI workflows. So our weight in Korea has gone up significantly. India is still one of our larger exposures across the portfolio, but we have funded our increases in China, Taiwan, and Korea primarily by reducing our historically large overweight in India. Now, stepping back, one of the questions that we get is India an AI loser? And we actually do not believe that's the case. One of the reasons why that question is often asked by investors is because India has a very large business processing outsourcing part of its GDP and economy. And as you know, as coding and developing tools have become very sophisticated, there's a fear that there's going to be less need for BPO businesses coming out of India. Two things. One is we feel like while these tools can be headwinds, particularly for pricing for these businesses, we think the fear is a bit overblown because there's still going to be a lot of consulting related and BPO work required for digital transformation for the Fortune several thousand companies around the world. And we think that the Indian outsourcers can be an important part of that. And so we don't think that those businesses are going away, and therefore they're still going to be relevant in the Indian economy. I think the other reason why we don't think India is an AI loser is because some of the largest multinational companies in the world are building what's called global capability centers in India. And we think the GCC employment in India is going to be able to offset many of the headwinds that the outsourcing industry is going to have in India. However, all that said, we think the relative attractiveness of India doesn't justify the same level of overweight, given the increase in attractiveness that we've seen in countries like Taiwan and particularly Korea, which is a good segue to the next slide. Probably one of the biggest differences about the opportunity for the emerging markets over the next decade versus, I first became a co-PM helping co-create the emerging market strategy in 2013. And for most of those years, up through the more recent AI paradigm shift and innovation, Korea was an underperforming market within EM. And we had very little exposure throughout most of those years. We would own a business here and there, but we typically have a pretty significant underweight throughout most of the history of our emerging market strategy. But a handful of things that have happened that have made Korea far more interesting going forward. One is obviously companies like SK, Hynix, and Samsung at the choke points in memory for AI, as I mentioned. Samsung is also the #2 foundry after TSMC for chip manufacturing. Those two businesses are roughly half of the Kospi and are significant beneficiaries, which is creating tailwinds for the economy. However, a few other things that people may not fully understand is that Korea, because of the presence of North Korea, has kept a very significant industrial base in the country, while many Western countries, US, Europe, have seen their industrial base decline or decay throughout the years. And that's put them to be very well positioned in some of the other geopolitical pivots that have been happening at the same time. So one of them is the undersupply of electric equipment, which is in part an AI trend, but also it's related to the electrification of many, many industries that we're seeing today, even outside of AI. The electrification of the automobile industry, the electrification of many industrial processes, for example. And there's a handful of Korean companies that sit at very important parts of the power equipment landscape. Korea is one of the key enablers in technology for nuclear and is one of the most leading nuclear power manufacturers of any country outside of China, for example. They also continue to keep a defense industrial base. And given the wars not just happening in Ukraine with Russia, but also the conflict with Iran, we're seeing significant increases in low cost but advanced defense equipment. Those are some of the areas where we expect to see continued opportunities in emerging markets in Korea more specifically. And despite Korea having a banner year in investment results in 2025, that's continuing through 2026. One of the most interesting things is the market PE multiple is actually lower today than it was back then. And one of the reasons for that is those very strong country level investment results, which have been concentrated in a handful of businesses, was largely driven, more than 100% driven, I should say, by explosive earnings power. Well, in conclusion, I'm more excited than ever about what the future holds for us for investing in innovative growth businesses across emerging markets. We have each of the big four countries, Korea, Taiwan, China, India, with significant growth opportunities and drivers that include an AI super cycle, but are far more broad and diversified than just that. In addition to those four countries, we continue to see significant opportunity across Latin America, which has 600 million people and a number of very innovative entrepreneurs. Same in ASEAN, which has a similar sized population of 600 million people. We're finding opportunities across Central and Eastern Europe, Middle East and Africa. Right now, I discussed quite a bit about choke points across the AI supply chain. That's creating significant opportunities. We think all of emerging markets is likely to have opportunities in terms of AI beneficiaries that are adopting the technology, including us continuing to scour for opportunities in South Africa within the financial services space, where we think AI can be a meaningful driver of opportunity for early adopters. So thank you for your time, and I love what I do, and I'm looking forward to the next time we're able to connect, and thank you for your support.
Thank you, Brian. Samir, I'll hand back to you. We've got a couple of minutes for questions.
Thanks, Eugene. I'll welcome back Ian and Lars to the screen. So we've heard two complementary perspectives, one focused on high conviction stock selection and the other on managing risk across the portfolio. I want to use the next few minutes that we have to connect those perspectives and importantly, translate them into how portfolios should be constructed. So Lars and Ian, to kick off with a question that is purposefully a little bit broad for the both of you. If I'm an allocator today, what is the biggest mistake I can make when implementing emerging markets exposure?
Okay, Samir, let me go first. Predictably, I'm going to argue that you're going to end up with too narrow exposure. All right, like the performance that we've seen, and I recognize that Sands Capital has also called out TSMC and SK Hynix and Samsung as some of the stocks that were on my chart. But within this very short space of time, these things have done extremely well. There wasn't necessarily anything to tell you at the time these were the stocks that were going to outperform. Now, I'm sure Ian will tell us otherwise, and I'm sure they've got some great researchers, but it can be very hard to get that right. Opportunities can come from anywhere. If your portfolio is very narrowly set up, there's a very high chance that you're going to miss from one of these unicorns essentially coming out of nowhere. So I would argue that the biggest mistake that you can make is that your exposure is simply too narrow, and you just don't have coverage in that area where something new is coming out.
Thanks, Lars. Yeah.
Yes, indeed. And really nice to see everybody. Thank you for joining this and for being a supporter of Sands for those of you in the audience that invest. So yeah, we have quite a different view on this, of course, as a single asset manager as opposed to a multi-asset manager. I think honestly the biggest risk that investors can take at this time is to underestimate just how globally significant the combination of businesses within emerging markets are right now and can continue to be going forward. I think a lot of investors still assume that businesses within emerging markets are, maybe great in their own countries or maybe great within emerging markets. But we would argue strongly for a larger allocation in emerging markets at this point in time. recognizing exactly the concentration that Lars was referring to, but flipping this on its head. These businesses which have grown significantly are not just great within emerging markets. These are, that many individuals would argue, as an example, that a TSMC is now the most important business anywhere in the world. TSMC will have higher revenues in 2026 than Nvidia, as an example. So these are globally significant, phenomenal businesses. And I think the biggest risk investors can take at this point is to underestimate just how important emerging markets are going to be going forward.
It's a very valid point. I want to zoom in from there to the next question, which actually talks to conviction versus risk. So in your presentation, Lars, you highlighted how cumulative underweights to major benchmark names created meaningful performance drag, or they can at least, from a multi-manager perspective. So a question to the both of you, but with that in mind, how should allocators distinguish between genuine conviction and benchmark risk, specifically when thinking about that point that you highlighted in your presentation?
Yeah. So I mean, let me preface that by saying we like high conviction managers, right? In fact, full disclosure, we actually have money with Sands Capital, right? So we like high conviction managers. The problem is if you put all your money with a single high conviction manager, then you're going to run an increased level of volatility in your total portfolio. So if you're willing to do that, then you need to be very clear about why that high conviction, why those deviations from your benchmark are coming about. Is it a style issue? So you've put money with a value manager and the growth stocks are currently in favor, so there's going to be some significant misweights. That might be something that you're quite deliberate, you're quite comfortable with, because it's somewhere else in your portfolio you've got offsetting growth exposure. It's very different if it's single stocks that you're not quite sure whether the manager has done their work, have they researched it adequately or not. Is it a kind of we're not too sure, but then they've decided to underweight it and it's quite a big name. That's when you start getting worried. That's when you should be thinking about, are there ways that I, as the allocator or the intermediary, can do something about the risk that my portfolio is currently running?
Yeah, I actually wouldn't disagree with that, Lars. I think that's entirely appropriate. It's absolutely true, of course, that a single manager approach, almost any single manager approach, will end up with higher benchmark relative volatility compared to a multi-manager approach. I think the other side of the coin, though, I'd argue for is that if you choose a fundamental bottom-up investment manager like a Sands, then actually the risk that we are trying to mitigate is not benchmark relative volatility. We are investing in businesses, not trying to trade in stocks and produce a tracking error relative to an index. So there is a reason why TSMC and SK Hynix are such large parts of our portfolio, and it's not because they're large parts of the benchmark. It's because they are fundamentally massively high quality businesses sat at a choke point in right at the start of a multi-year, multi-decade, in our view, secular growth trend around the world, and they're effectively monopolies, and that makes them phenomenal investments in our view.
I think this next question might actually test that a little bit. But it also, I'm going to build on the previous question. So, Lars, this speaks to the interventions and techniques that you highlighted in your presentation about managing risk. So, this one is first directed to you. What specifically triggers intervention in your process? When do you think it's the right time to step in with ETFs, futures, or overlays, as opposed to what Ian is talking about, letting the managers kind of play out their philosophy and their process with their long-term views?
Yeah, no, and I appreciate that, and I suspect you're hoping I'm going to give you a numerical answer that says, if the misweight is greater than X, we step in. Unfortunately, it's much more art than that. So I think it depends on what is causing that significant misweight. So on the one hand, if it's caused by what we call a governance reason. So, for example, in China, there are a lot of state-owned enterprises, like there are in South Africa as well. And if the managers are underweight a state-owned enterprise because of a governance reason, that they don't trust the numbers, it's not working for the shareholders, etc., then we would be quite comfortable with an underweight. And actually, we would be happy to suffer underperformance and explain to our clients that says, look, we couldn't invest in this company because the governance was all wrong. You didn't want you wouldn't have wanted your capital allocated to this business. There will be times where that business does well from a market price performance point of view. You're going to suffer underperformance, but honestly, it's fine. You need to have just weathered that. On the other hand, if the underweight is through, and either a lack of breadth on the part of the manager, so they simply can't cover the waterfront. They haven't got the resources to cover every single stock. They've avoided something out of the benchmark that was quite important. Then we might step in. Or, if there's some uncertainty as to whether their research really is deep enough and thorough enough, then you might also say, look, we hear what they say, but that position is simply too big and underweight. We're going to step in. But it is very much an art versus science thing. There's not a single number I can give you that says, step in at this point.
I can appreciate that. And I think, yeah, that's a helpful portfolio perspective view. I want to bring in Ian here. So if I think about portfolio management like owning a well-built ship on a long voyage, your role at Sands Capital is to set the course based on fundamental conviction, while others may be more inclined to make adjustments along the way. So from your perspective, where does too much short-term risk management start to interfere with that journey and actually detract from long-term alpha?
Yeah, it's a very good question. I must apologize. We're in the middle of a rainstorm at the moment, and I've got it hammering down on the roof above my head. So welcome to the British summertime, if there's a bit of interference. Yeah, we think very, very carefully about this, because ultimately the value that we've managed to deliver to our clients over the long term has generally come from positions which we've held for a very long time, and allowing the brilliance of the management teams and the competitive positionings of these businesses to generate a value for shareholders. But we do recognize that there can be short-term instances where the valuation of the stock price, as an example, will become dislocated from the fundamental value of that underlying business. So, and actually, if you look around the world, not just in emerging markets, it has definitely been an issue that shorter term price moves in stocks have become much, much more aggressive and much, much more emphasized in recent years. The influence of the retail markets in the US, in Korea especially, being two great examples of that. So what we try to do is always be anchored to the fundamental value of the businesses. And if we need to take a little bit of risk off the table because we think the valuation has got ahead of itself, then we will do that by trimming our positions. But ultimately, what we are looking for is, is the business case broken? Will the business still continue to generate above average earnings? And if so, then we should probably continue holding that business through the cycle.
Thank you, Ian. We're almost out of time, everyone, and I think that's a strong note to end on. I see Eugene's popped up to discipline me, but maybe just quickly in closing, considering all that has been presented and discussed, I think what's clear is that emerging markets is not just about where you allocate, but importantly, the manner in which you allocate and access the opportunity. And from listening to both speakers, I think that choice will ultimately define both the risk you take and the outcome you get. So I want to thank both our hosts and presenters and our audience for your interest and attention through the session. Back to you, Eugene.
So, thank you very much for making interesting conversation. And Lars and Ian, thank you for joining. I see there is some open questions from the audience. We will circulate those questions to both Ian and Lars to try and get some responses, and we'll give you feedback on that. Again, gentlemen, thank you for your time this morning. We really appreciate it. Right, for our next session, we will be joined by founder and managing director of Gins Global Index Funds, a boutique firm operating across 10 countries with excess of $8.5 billion in management. It's an absolute privilege to welcome a gentleman that needs very little introduction to this audience, live all the way from Los Angeles, California, Anthony Ginsberg. Good evening, Anthony. I almost said good morning, good evening.
Eugene, great to be with you, and thank you to everybody for your support. You've given me a tough task here just to run through a couple of slides about both the indexing revolution, but also the outlook. I'm joining you from the land of the fiscal stimulus, Eugene, and the land of the tax refund. Even guys like me probably don't deserve a tax refund, but even we got tax refunds here. So the shops are busy, the airlines are busy, the prices have gone a bit crazy, but we don't see any recession on the horizon. I'm going to just go to the next slide and just briefly introduce us. We've got two funds with you in yellow there. The one is almost at 2 billion rand. So we thank everybody on this call and the BCI team in particular over the last 3 years for the MSCI World. Our global equity index feed is almost at 2 billion rand. It's up about 15% year to date. Obviously, we've had a very good run. And then we've also got this tech megatrend feeder fund, which is a comprehensive broad tech megatrend product that covers actually the global markets as well as emerging markets, not just the US like the NASDAQ. So we're much broader than the NASDAQ and we're equally weighted. And that one's it's fast approaching 150 million and it's up 26% year to date. Obviously, we offer a range of other offshore index funds. We've partnered with State Street for a quarter of a century now, and we have ETFs also listed on the LSE in London, the etc. DAX and the Swiss exchanges. But this morning, I just wanted to really address what's going on here in the US. And I know some folks are concerned, but truth be told, the fiscal stimulus, this is Trump's big, beautiful bill from last year. It's really pumping a lot of CapEx expenditure from AI data centers to consumer spending through the US. Obviously, the gasoline prices, the petrol price from the Iran war is slowing growth, but there's still GDP projections here of about 2 to 2.5% GDP growth for the year. So that's the prediction. And the latest inflation numbers actually came off slightly. So we'll just go to the next slide. And I just want to briefly put it in context what's going on with portfolios in America. There's been a huge sea change, really an indexing revolution since the early 2000s. If you go back the last 15 to 16 years, the flows in trillions of dollars have been massive into passive and into indexing as a core part of most institutional and IFA portfolios here. And that's the navy blue, dark blue area, and also the red, the index mutual funds, the index ETFs, and the outflow on an almost annual basis out of traditional fund managers. It comes down to performance, which we'll get to in a moment. Let's just go to the next few slides just to reiterate this revolution that's occurring in the mutual fund space where I'm based here in the US. Currently, 58% of all the assets held have sitting in passive and index, and that's because CalPERS and other very large pension funds are all essentially using indexation as the core to track whether it's S&P 500, MSCI World like we do at very, very low costs and to get as broad an exposure as possible. You'll see the growth since 2005 on the left axis has been massive. It was about 20% back then, and now it's almost at 60% for passives, and active has basically lost significant market share. But we still believers in a blended approach. That's how all the large institutions and wealth managers work here. So we'll move on. And this just shows you in yellow essentially what's happened in the passive space, how much growth we had in the last 15 years from 2011 through to 2018. In yellow, you'll see the passive AUM assets grew over 200%. And then in the last 7 or so years, over 100%. So that's why it's now over 50-50 in terms of passive holdings. The next slide actually summarizes this in a nice way. If you look at the green bars, those are in billions. So on average, about 500 billion has gone into the S&P 500 and other mainstream indexes here over the last 10, 11 years. And in gray, you see the bars, essentially almost every year, the traditional fund managers, active fund managers rather, have slipped and have had an outflow. And the reason for that, it comes down to performance. So we'll just quickly look at the performance over the last year and 5 and 10 years. So the next slide shows, on average, the most large cap fund managers here, traditional fund managers, Eugene, in the US are struggling. Only 25% actually last year and currently this year are actually beating the S&P 500. That's on an annual basis. Those yellow bars you're seeing generally average in the last decade or so below 40% of active fund managers actually beating the S&P 500. What's scary is if you go to the next slide and you look over 10 years, on the right-hand column in yellow, it shows the percentage of American fund managers underperforming over 10 years. The S&P 500, which is the large cap, it's almost 90%. It shows 85.6. And you can look at mid caps and small caps and the overall US equity market. It's really like finding a needle in a haystack to actually outperform on a regular basis with traditional fund managers. And that's why you've had this indexing revolution. Low costs are certainly a sizable component of that reason. And also the fact that back in the great financial crisis, many folks were burned by certain fund managers that just didn't hold up too well under the stress. So we'll go to the next slide, which shows also globally, when you look at MSCI World or the S&P World, which is a very similar benchmark, over 10 years, this is the column on the right-hand side, the final column, 93% on a global basis. These are American fund managers failed to match the benchmark. And then if you just exclude the US and you just look internationally, or even in emerging markets, again, it's in the high 80% range of American fund managers struggling to match their benchmark. So we'll just move on, but that's really the context of where we're coming from and why we see indexing being a prudent approach. It's low cost and it can be used very easily with Core and Explore. And that's why with BCI, we're very pleased to have partnered with you guys over the last 3 years. I'll just go to the next couple of slides quickly so you can see that really it's an asset allocation tool. At the end of the day, using MSCI World, yes, it's somewhat American dominated at the moment. It's just over 70% America, but we don't have the overhang of a Naspers or a couple of huge stocks, that may control or represent 15 to 20% of the index. The biggest weightings would be some of the IT boys. Obviously, we've got NVIDIA and Apple and Microsoft, but something like JP Morgan is just about a 1% weighting. Meta, which is Facebook or Tesla, are just at about 1.3, 1.4%. The biggest one, NVIDIA, would be just over 5%, with Apple hovering around 4.5%. So our main point is that it's an expensive gamble when you're picking certain active fund managers abroad, and that's why it tends to be the nature of asset management, certainly in the US and in Europe increasingly, where indexing is used as the core foundational building block. The next slide is just an example of why MSCI World has been the cornerstone for most global investors, because emerging markets, although they've had a nice run recently, they've obviously had some struggles over the past decade. So MSCI World in the navy blue has outperformed even the global all-country world index, which some people use. That's the turquoise line. The next slide is actually perhaps more interesting because it shows if you excluded the US, then you really lost out. So MSCI USA, which we also cover, on its own did something like over 530% over the last quarter century. Whereas if you excluded that and you only bought the MSCI, excluding the US, you would have done significantly poorer. You would have been basically performed about 1/3 as well. So although some folks think the US is overvalued, that's where the growth stocks are, and that's where you obviously access the likes of the Apples and the Nvidias and others. So we don't see a bubble right now. I'm going to address that with the tech megatrend fund that we have, which actually is global and has an average PE ratio of only in the low 20s. So there's a way of actually diversifying beyond just the Mag 7. And that's why we think indexing is a very prudent, broad scale approach. The next slide will just highlight that you would have essentially tripled your money over the last 10 years. This goes back to the end of 2025, so it actually would have grown even substantially more. But over the last 10 years, the annualized return in dollars is 12.2%, and $100 would have been worth almost $300 today. And over 5 years, that $100 would have almost doubled to about $185. So it tends to be a very prudent approach. So we'll just go through to the next slide. Incidentally, we're offering this with BCI now for the last couple of years, around 33 basis points TER. And generally they're 1,300 approximate shares total. There are 23 developed markets that it covers. So you've got 1,300 shares. I mean, the US is the largest weighting, but I think what's important to also focus on is if you use a large global player. They can reduce the cross-border taxes because they're cross-border dividends that flow across these mutual fund parameters. And it's very important to consider that coming out of the US, dividends and even interest payments can be hit anywhere between 15 to 30% withholding taxes. We've actually worked with State Street very closely to ensure that we actually match the benchmark very, very closely because of the tax reduction strategies that they have across 20 plus offices. So that's certainly very helpful in generating additional returns. If we go to the next slide, I think you'll see that if you exclude the Mag 7 out of the S&P 500, your PE actually drops for forward PEs essentially around 20 times for future earnings. So it's not a massively bubbling market. We don't see a bubble yet. Actually, if we compare it to the internet bubble of 25 years ago, those with gray hair and have been around for a while, it's quite different because these are subscription-based cloud computing companies, cybersecurity companies, even on the AI stuff, these data centers that have been built out in Arizona and across the Southwest in the US in particular. Many of them are already pre-leased, 80 to 90% pre-leased. And the guys aren't blowing money on FA Cup or Super Bowl advertising with no revenues coming through next month, which was the problem with the internet bubble. These are all subscription-based and they have very, very strong cash flow earnings. If I put my old accountancy hat on, the earnings have been very impressive. They've generally, for the first quarter this year, the S&P had earnings gains of over 20%. And the prediction by Goldman Sachs and most analysts are that we're sitting essentially for the year at about a 20% year-on-year gain in earnings. That's really what's pushing up the market despite the Iranian war. So many folks see the broader market as being reasonably cheap. Even Micron and these other shares that many have heard of are not trading on PE multiples beyond 20 times. The next slide may also be useful in this space, just to briefly talk about the outlook. So we had a 90% of all the 500 companies in the S&P beat the earnings predictions. We think that the Iranian war, when it comes to a ceasefire or a truce shortly, will be a boost to stocks. We know Trump is under pressure to obviously finalize some sort of a truce ahead of the midterm elections, which will be an interesting development here, because if you actually have a truce, not only do we expect a boost to stocks, but the consumer sentiment will certainly improve. Gas prices, we've already seen the oil come down 20% from its highs, but we're expecting oil to come off another 10 to 15% shortly after the announcement. So we don't expect a US recession. I'll just say one other quick thing. Trump ultimately may not be the most popular president globally, but he's seen as business friendly here in the US. And he's allowing more M&A. There's been a huge uptick in the M&A activity in America. Under President Biden, they blocked a lot of tech M&A, and that's actually helped our tech megatrend fund really, because there are a lot of acquisitions at the second tier, below the Mag 7, so below the mega caps. I'm talking about the large caps, some of the mid caps. You've got a lot of acquisitions and corporate activity between cybersecurity companies, cloud computing companies. It's very hard to time these things. And that's why we think a broader index approach makes sense. I will just say that on tech, the US does not have a monopoly on brains, and there are amazing robotics companies coming out of South Korea, memory chip companies coming out of other parts of Asia. The Japanese are also leaders in robotics. So you heard earlier about Taiwan Semiconductor. So we definitely have a global benchmark, unlike the NASDAQ, which is 100% American, and frankly, 50% of it is made up of the Mag 7 with two other stocks thrown in. I will just say lower taxes and a weaker US dollar also help boost earnings in this country. So the weaker dollar for us has not been a problem. It's a positive tailwind. Let's just move on to the next few slides. And I'm happy to take some questions. Many of you know that the unemployment rate here is very low. It's at just over 4%. We actually produced 150,000 jobs in the States. So I guess the bottom line really is positive earnings going forward, closer than 15, maybe even 20% earnings per share gains for the year. And sentiment remains positive. Of course, we have the World Cup coming up here a year and a half from now, almost 2 years from now. In my hometown, LA, we have the Olympics. So there's a lot of infrastructure spend beyond just the AI data centers. let's move on to the next slide. And just to summarize on tech, this M&A activity shouldn't be discussed, because it's actually creating basically boom times for more and more of the second-tier companies looking to be acquired. And we've also seen robotics and outsourcing being a space that has been helped by the current administration, basically reducing the red tape and regulations and pushing to onshore. And actually, the robotics are amongst the biggest beneficiaries. Just the last couple of slides I have before we take questions is that we've got 10 mega trends from robo-taxis. If you drive through Beverly Hills or even other parts of the United States, Chicago, Arizona, many other states are now introducing robo-taxis. I can tell you, driving in Los Angeles, if you look left and you look right, you often see more robo-taxis around you than regular cars. And I think, interestingly enough, the biggest users are females who often find it a lot safer and more comfortable to use a robo-taxis, particularly at nighttime, being picked up from airports and hotels. But we've actually looked at 10 of these sub-themes. We've added quantum computing some time ago, which has also benefited from recent changes in the White House. They've viewed quantum computing now as a key strategic endeavor alongside AI. But also defense technology with drone technology is also a core component of a tech megatrend outlook. But of course, the mainstays remain AI, robotics, cybersecurity, and cloud. And cloud computing remains the biggest buyers. Essentially, these are hyperscalers. They're the biggest buyers of NVIDIA chips and much of the AI usage that we read about day in and day out. But it is a global phenomenon, this is a global infrastructure story, not just a tech story, we would argue. The last slide refers to the fact, I think, just move on, we have 140 holdings. And what we've done is, in this index, it's rules-based. We have basically 15 leaders for each of these categories. Very hard to time which one's going to outperform the next. April, the performance was 16.5% in yellow. It was a very good run. At the moment, there are only 5 quantum holdings because there are not enough sizable pure quantum players. But the best performers last month, just as an example, Future Cars did 36%, and AI and robotics on their own did 44%. It's like the Premier League table with Arsenal winning. If I can go to the next slide, just to show you what I mean by the Premier League. Every year, it's so difficult to predict. So you could have Future Cars last year in green in the top 2025, and this year robotics happened to be number 1. But 2 years ago, it was digital entertainment, the likes of Netflix and some of the other players in that space, Hulu, etc. But if you look at the yellow bars like blockchain, it's all over the show. So we own blockchain. We know it's not going to be a top performer probably this year, but it's just very difficult to time these things. So with that, I think there was one last slide, and Eugene, I'm very happy to answer any other questions. This just shows the relative performance of tech and why we realize it's maybe a relatively small slither in someone's portfolio, but it's certainly not worth ignoring. And there's a way to invest in tech on a broad basis globally, beyond just the NASDAQ. And in red, that's our Tech Megatrend Index Fund, outperforming both the MSCI World and the S&P. Well, thank you, Eugene. I'll turn it back to you.
Anthony, very insightful indeed, as always. We've been flooded with questions from the audience. We're not going to get through all of them, but I'm going to take 2 of his questions very quickly. My first question, and it speaks to part of one of the audience questions as well, and like you showed on those graphs, it's this massive flow to index funds in the US, far exceeding flows to active managers. And I've always said, passive funds or tracker funds are not passive because you're actually tracking market momentum, but there's always also a saying, momentum is your friend until the bend. Isn't this becoming dangerous territory where this massive capital flows to index funds are actually feeding some of the top companies and driving price, and the driving of price is no longer based on fundamentals?
Okay. That's a fair question. We're still far away from a situation where the indexing on a daily traded basis is dominating. The hedge funds, the active traditional fund managers, they're still making very active markets. Arguably somewhere between 75% and 80% of daily trades are still being done by traditional fund managers and not the index guys. So yes, on the AUM, Eugene, you're right. It looks like it's over 50%, but most of those guys are buy and hold characteristics. So if you look at the likes of the big California pension fund, CalPERS, or the New York Teachers, or the Ontario Teachers funds, these guys are not active traders. So one of the advantages really quickly on indexing is that we don't really churn our portfolio very much. The average turnover ratio for an index fund is between 5 and 6%. So it's very, very low turnover and very low trading, whereas traditional fund managers, depending who you talk to, may only have a much smaller number of holdings, and they will trade anywhere between 5 to 10 times as often as an index fund. Their turnover ratios could be in the high 20s, 30% type level. So the index funds are not dominating trading on a daily basis. That's my main response.
Right. I'm going to take one more interesting question from Dean, and it's with regards to the listings of the likes of SpaceX and OpenAI. Do you see the listings of these companies impacting the S&P 500 index in terms of capital being taken out of smaller names being allocated to the new incomers? And have you done any impact calculations of this?
There haven't been any specific impact calculations, but the truth is we don't actually see a misallocation. At the moment, yes, these are going to be some sizable IPOs. No one's particularly worried about the capital being taken out of smaller names necessarily. Look, you're going to have some speculators. There will be probably a volatile ride for some of these OpenAI and SpaceX investors in the first couple of weeks, because you know that there'll also be some sellers. Not that they're forced sellers, but there'll be people who've been hanging on for years in these products or in these companies. So it's exciting times. It actually shows that the IPO market is very healthy, Eugene. So the good news here is animal spirits are back in the US. If this war can be put behind us, it'll also help sentiment. But fundamentally, the US is growing at about a 2.5% GDP growth trajectory before the war. Hopefully, we'll get back to that if the gasoline prices go down. But our main point, just to summarize, is people are spending here. Airports are busy, restaurants are busy, and robo-taxis are increasingly ubiquitous over here. So don't count the Yanks out. That's the message.
I want to see how robo-taxi is going to work in SA. Last question, just as a matter of interest. The tax refunds everybody's going, because I mean that's obviously boosting the US economy. What are people doing with those tax refunds? Are they blowing it or are they saving it? What are you doing?
Yeah, most of us and folks, my friends here in LA, they would be investing it actually in the market. This is the one thing that we don't talk about compared to the JSE. In America, you've got these 401k plans. You've got ISAs, obviously, in the UK, but people are actually forced in the US basically to reinvest their a portion of their salary or their savings back into the market. There are these tax-saving wrappers. So there's a flood of money, Eugene, basically every month from pensioners or from people pre-retirement going into the market. And that's what folks generally are doing at the higher end, I would say, with their tax refunds. The lower middle class, and we do talk about a K-shaped recovery, people who are struggling, they're certainly paying off bills and, maybe not investing as much in the market as others. But anyway, there's a strong equity culture here. And I think that's also what needs to be understood by folks in South Africa and in Europe. The equity culture here is very strong.
Almost an unstoppable virtuous cycle. Anthony, I'm going to pass it there. There's a couple of open questions from the audience. We'll get that through to you. But you can answer that tomorrow. I know it's very, very early morning on your side. Thanks again for staying up so late. We're really grateful for your time. Thank you.
Got sense. Thanks.
Got sense. Well done on that one. Right, we are moving on global equity views, and here to moderate our next session on global equity opportunities, all the way from Hollard Investments, is Ashvina Tilaktari Kushal. Ashvina, thank you very much for joining us this morning and again preparing for these sessions. She will be joined by CEO and Portfolio Manager at Sifter Fund Managers. They are based in Helsinki, Finland, Santeri Korpinen and Alexander Jarf. Gentlemen, thank you very much for joining us this morning. We also joined online from all the way from London, presenting or representing Guinness Global. We're joined by Sagur Tanki. Sagur, thank you very much for joining us as well. Really grateful for your time. With that, Adrenal, I'll hand over to you. Thank you very much.
Thank you, Eugene, and good morning to everyone and to my fellow panelists. Global equities, particularly developed market equities, make up a significant portion of offshore allocations in SA multi-asset portfolios. For our local investors, this exposure is absolutely critical because it is our gateway to industries, innovations, and growth themes that are simply not accessible domestically. Over the past decade, we've also seen a meaningful expansion in the number of global equities strategies available, from more feeder funds to Section 65 approved funds, effectively giving our investors far more choice than ever before. And with that choice comes a greater need for clarity because not all global equity strategies are created equal. At the same time, the market backdrop has become more complex. Like the previous presenter showed, passive investing has dominated flows. Many active managers have struggled to outperform the market benchmark, and market indices have become more concentrated in a handful of large cap names, or like the previous presenter said, the IT boys. Raising important questions around diversification and the role of active management. Now, overlay that with today's market dynamics, where global equities are being shaped by two powerful forces at the same time. On the one end is AI supporting earnings and risk appetite, and geopolitics, inflation, and energy markets driving uncertainty on the other. And it becomes clear that a more selective approach is required. As a result, many investors are shifting their focus on resilience, turning to strategies that prioritize quality to navigate both this concentration risk and macro uncertainty. So the discussion today is really about this, how to build resilient portfolios where risks may be underpriced and what quality really means in today's market. With that, let me welcome my panelists who bring contrasting but highly complementary perspectives on navigating global equity markets. I would like to invite the SIFTR team to kick off our presentation.
Thank you. Thank you very much, Ashvina, for your kind words. I suppose you can hear me well.
Yes, Santiri, maybe just for the sake of the audience and apologies for interrupting you. So, as I mentioned with the opening, you are based in Finland, managing the SIFTR fund. We've got on our side representatives of your company is the Bellamont BCI Global Equity Fund that feeds into the SIFTR fund. So if the audience wondered why the logo Bellamont at the end, that's how the dots connect, and that's how you get access to SIFTR. Santiri, thank you.
Well, thank you, Eugene. That was exactly my point. Now it's very clear to all of us, and some of you may already have heard about SIFTR fund, but let me walk you through the core principles, the investment process, and the performance. So SIFTR is not a new name in quality investing. We are a Luxembourg-based UCITS fund with a 23-year track record now, a concentrated portfolio of high-quality businesses, and a single dedicated team based in Finland running a single strategy. And since day one, the fund has outperformed the MSCI. So let me show what it means in practice. This chart shows the fund's performance since 2003, the same strategy, the same process, no style rotation. The current investment team, myself including, took over 2016, and since then the fund has ranked in the top quartile in 7 of the last 10 years, delivering approximately a 10-year annualized return, 12.7% in USDs and after all the fees. We don't manage short-term performance, but maybe it's worth noting that the fund was up by 9.7% in end of April and 16% year to date. So what exactly separates us from the hundreds of other active managers claiming the same strategy? Well, I think the difference lies in our process and decision-making culture and in the businesses we own in the portfolio. I want to highlight here on the right-hand side only one thing, because it's quite a busy slide. But here we can see that the over 80% of the current exposure is B2B market leaders, 60% in technology and industrials. Why is that? Well, over 2 decades, we have found that B2B businesses offer something rare: predictable recurring earnings and genuine pricing power. And that's exactly what you want in a long-term compounder. So let's look at the specific names in the portfolio today. So here we have our top 10 holdings. And as you can see, the result is highly differentiated portfolio. Names like Safran, Deutsche Börse, and Canadian National, they are not typical holdings in a global equity fund. Costco is the only pure B2C business here. And most of these names we have held for over a decade now. And that's the holding period our process and strategy is designed for. So let's look at the team, investment management team, and which is a very specific culture and distinct edge. Let me tell you a bit about who we are and what we do. Well, we think ourselves more like a research house with an engineering mindset than a traditional investment firm. Most of us hold both engineering and finance degrees. We believe very much in analytical, disciplined decision-making. So every decision is made collectively after deep fundamental research and, of course, rigorous team debate. And it's never an individual conviction. Here you can see the 7-people team involved in a portfolio decision-making. The investment committee on the left-hand side brings decades of experience running multinational companies, and their role is to bring that perspective and challenge our thinking. Well, ultimately, portfolio managers and I carry full responsibility for every position and decision. And critically, we are also owners of our business and investors in the fund ourselves. So our interests are nicely aligned with our investors. Well, this brings natural questions. How do we define quality and how do we choose those quality companies? And my colleague, Alexander, one of the portfolio managers, will continue from here.
Thank you, Santeri. And how do we invest is the main question. And on the next slide, you will see the 4 main criteria that we are looking for in every investment candidate that we look for Shifter Fund. The first one is that we invest into a company that has a long-term predictable growth opportunity. The idea here is that we want companies to reinvest capital at a high rate of return for the long term, because that's how you ultimately increase shareholder value. For example, TSMC, well, we heard TSMC pretty many times already today, but it's a great company. They invest between $30 to $50 billion in capex every year, with return on capital above 30%. So they are growing the value of the business in the long term. We also want companies to have a very strong and also very durable competitive advantage. We want companies to have an unfair edge that allows them to take the lion's share of this expanding market. Take, for example, Safran, a French company that make engines for aircraft, and it's very high barriers to entry for anyone else to come out with a competing product. We also favor companies with a solid balance sheet. We like companies with a good management structure. They should be focused on doing just one thing, but should be doing that thing very well. And lastly, we prefer companies, of course, that have a good and attractive valuation. The valuation that we make is based on our own forecast, using a good margin of safety incorporated into that when we make the final decisions. Now, next slide here. We are not top-down investors, but anyway, we don't look at the macro, we don't look at thematics. I'm not saying those are bad approaches, but that's not our approach. Our approach is truly bottom-up. And the way we go about finding companies is that we have this elimination process. We try to eliminate companies in different stages. The idea here is that you sift away all the bad companies and you should only be left with the good ones, right? The opportunity set is essentially 65,000 listed companies in the world, but that's too much for us to go through manually. So we have this stock sifter tool that, based on past fundamentals performance, sifts away the lion's share of that, leaving us with maybe 500 up to 1,000 companies that are potential quality investments for us. We then take a quick look at these 1 to 2 days, try to find reasons to eliminate. For example, maybe there is some suspiciousness in the shareholder structure. Maybe we cannot quantify the disruption risk for AI, so we eliminate the company as quickly as possible, leaving us with maybe 50 companies in a given year. They take a deep dive into up to 6 weeks, go through the annual report, call the company, call the competitors, do channel checks, everything that you do in a proper due diligence process. And based on that, we still have to meet the last hurdle, which is the the collaborative discussion with the rest of the team. All the investment decisions that we do are made jointly. The idea here is that my colleagues, Santeri and my 2 other portfolio managers, they will challenge my view. They will try to identify the blind spots that I haven't found, or they will try to highlight that maybe you are underestimating this specific risk factor. By doing this, we have been able to avoid making mistakes, because even though we are moderately smart people, we all have flaws, psychological biases, but as a team, we can make better decisions on average. That's the idea. Now, next slide here shows a little bit more detail how we are evaluating companies. I'm not going to go through all of these points, but I'm just going to highlight a few things. For us, understanding the business model is really important. How do they make money, and how does that flow down into the bottom line? How does this company has the opportunity to grow its presence in the long term? And is the durability of the competitive advantage strong enough that 10 years down the line, it's still going to be the leader in whatever niche it operates in? We, of course, also have to understand the risks. And lastly, the valuation. So all these 4 factors are then combined into what we call the kind of quality score for a company. And based on that quality score, we can compare one investment opportunity to another. And the outcome of this is that we have this ranking of the portfolio that is a guideline for us to allocate the capital within the fund. And of course, valuation changes daily. We get more information about companies on a quarterly basis. So this ranking also naturally then changes, at least on a quarterly basis. And then that lets us to make changes to the portfolio for the next quarter. That's the general idea. I will next go through a few quick examples to get some more flavor about what we think about companies. I already mentioned Safran. We've been holding it since 2015. Really great company. And the thing that we really like about Safran is the predictability of the earnings. Safran makes these engines, but the big part of Safran's earnings potential come from the aftermarket, because these turbine blades, they wear down, has to be replaced, engines has to be maintained. And that's the source of high margin revenue that is surprisingly well predictable for this specific company. In a nutshell, that's why we like Safran. The next example, to completely different business, this is Costco. And even though it's a traditional retail company that sells milk and bread and flat TVs to consumers, they do things a lot differently. They don't make any money on the said products I just mentioned. Instead, they make all of their profit essentially from this membership fee that every customer shopping at Costco have to pay annually. And that's a very predictable and growing source of earnings, hence why we like Costco. The last example here, well, the well-known TSMC, which we also had in the portfolio since 2016. And while we do not know how the future is going to look like, we haven't been invested into NVIDIA ever, for the reason that we cannot really know that in 5 or 10 years down the line, is NVIDIA chips really going to be the #1 chips, or is there going to be a challenger for Intel or Qualcomm or Broadcom or Google's own TPUs? We don't know who's going to make those chips, but we know that TSMC will be the manufacturer for those chips. So indeed, it's the narrow bottleneck in this value chain. And indeed, it has a very strong, impossible to remove competitive position as well. Then next slide to summarize, we are a bottom-up investors only. We don't take a view on the macro. So what you see here is just a snapshot in time, how the portfolio looks like today. 1 year ago, this was different. 1 year in the future, it's also going to be different. We go where our model tells us where the good opportunities are. But as of today, well, this is actually last of April, we are slightly overweight in Europe. We slightly overweight in technology and industrial companies compared to the broader index. And maybe one last point as well before we move on to the Q&A or the next presentation is that we are an active manager. So we do take active decisions as well based on our own model, which is then based on the internal discussion for every investment case, at least on a quarterly basis. And this year has been seen a very good run by semiconductors. As we all know, we have been having a good exposure to those because 1.5 years ago, they were very attractively valued. But today, we are seeing a lot more unpredictability how the cycle is going to go in the future, while the valuations are all really high. So we have been reducing heavily our exposure to some or many of these semiconductor stocks. And indeed, we have been finding better opportunities in more
Thank you, Alex.
boring companies. Yeah.
Apologies for stopping you there, just in terms of time check. Do you need another 2 seconds to wrap up?
My last point that we have been finding better opportunities, more traditional sector, we invest into rationale, which makes convection ovens for professional kitchens. And yeah, there's opportunities everywhere in the world, not just in the AI. That's my conclusion.
Thank you very much. Thank you, Alex and Santeri. I would like to now invite Sagar from Guinness to present. And by the way, it's Guinness that manages quality portfolio. It has nothing to do with the one measured in pins.
Thank you.
Sagar. Thank you.
No problem. Thank you. I'm hoping you can see my screen. I understand I'm keeping you. Well, it's me between you and the tea break. So I'm gonna dive right in. But what I want to talk about is essentially how can you invest for a future no one can predict, and more specifically, how can you invest so that you can sleep well at night? But before I talk a little bit about that, a little bit of an intro. At Guinness Global Investors, we run about $11 billion in assets. We do long-only investments, and we were founded in 2003. We're not related to the brewery. Usually that's the elephant in the room. We are an independent asset manager. And our largest fund is a global equity income fund. And we also have a BCI feeder fund for this. This has about $7 billion in assets. And the focus there really is on quality, value, and dividend growth. But what I want to talk about is a little bit of the current market environment. What are the risks? We've obviously heard a little bit about AI bubble already. And then where can you defend against some of these risks like geopolitics and an AI bubble? I'll rattle through some of the next few slides very quickly. But this year, if we look at the MSCI world, we've broken it down into 3 periods. And really the first was January and February, where we had the geopolitical noise with Venezuela, Greenland, Canada, even Japanese yields. And we had, I guess, the so-called SaaScopocalypse, where we saw a number of software companies have quite a sharp sell-off as they were potentially being replaced by AI. Period 2, really the Iran war and the oil crisis. And then period 3, we've seen a market rally really driven by AI and a very good earnings season, particularly from many of those companies. If we take the first sort of point with regards to geopolitics, if we look at the red line, this is the performance of the MSCI World 30 days after the conflict started. And you've got various other conflicts on the right labeled. Actually, this was one of the sharpest drawdowns in the market that we have seen relative to other conflicts. Saying that, actually at the bottom there, we had the fastest ever recovery from a 9% loss in the S&P 500. So actually markets recovered very, very quickly. The real reason for that is actually when we look at this chart and we think of the Strait of Hormuz closing, actually, if we look at the black line, this is the oil spot price. There was some volatility post that period. But the green line is looking at what would the oil price be at the end of the year. And you can see actually a small increase from around $80 a barrel to around $90 a barrel. So actually what markets are really saying is that those oil supply disruptions are perhaps more temporary and permanent, and this will all be resolved. So the market looked through that to some extent. And we can see that when we look at the fear index, the VIX index, that actually there was a little spike, but nothing like when we saw Liberation Day or the tariff announcements last year for comparison. Why is oil important? Well, really, it's the impact on inflation and subsequently interest rates. And we can see that inflation in the US on the left has been quite stubbornly above that 2% mark post-COVID. And forecasts this year have sort of ticked up as a result of potentially higher input costs. What that has meant, combined with lower economic growth forecasts, is that actually the interest rate forecasts have gone up slightly, and you can see that on the right-hand side. And this is in the US that we're predominantly talking about. But really then the fear is that are we going to get into a stagflationary environment where we're seeing lower growth and higher inflation? However, when we look from a more bottom-up perspective, actually in the different regions, we're seeing good earnings growth. And this is for 2026 and 2027. You can see across the regions at the bottom and across the Mag 7, we're seeing sort of almost 20% sort of earnings growth in the next year or 2 years. When we then look at the year-to-date contribution by various different industries, it's no surprise that semiconductors have been the best performing, capital goods also related somewhat to the AI trade, and then energy. So the three areas that have outperformed the most have really been related to what's going on in the world with regards to geopolitics and AI. The one standout area that has underperformed, software and services, and that was predominantly in January and as a result of perhaps AI replacement, as I mentioned. However, what that has meant is when we look at the S&P 500, the top 10 now make up about 40% of the weight, which is actually a record. If we look at those holdings, these are household names now, and actually predominantly related to tech and to chips. So that's one of the concerns that has arisen from this sort of AI trade. And it then raises the question that, is this sustainable or are we in an AI bubble? And we've heard quite a bit about that already this morning, so I'll keep it brief. But really, the key thing to note here, or the key worry, is that what is the return on CapEx? So the hyperscalers, the 5 companies, Amazon, Alphabet, Microsoft, Meta, Oracle, that are listed at the top, are expected to spend about $730 billion in CapEx for this year. And those estimates, as you can see, have been going up month on month for the last sort of 6 months and prior. What that means is that these 5 hyperscalers account for 37% of the S&P 500's CapEx. So 5 companies accounting for 37%. And you can see in the blue line there how that has ticked up over the last decade. Relative to the sales or revenue share of the S&P 500, that has ticked up, but by nowhere near as much. If we then look at the CapEx relative to cash flows, actually it's ticked up, but probably still sustainable or there's still some way to go. That actually, bar Oracle, the other companies are spending about 66% of their capex, of their cash flows on capex. Oracle being the outlier, spending more than 100%, and hence raising the question as to whether that's sustainable in the long term. If we also look at many of the leading AI companies like OpenAI, Anthropic, we're seeing rapid growth, but we're also seeing that many of the deals are increasingly circular. And that is adding to some of the worries that the market has, sort of supporting an AI bubble. But reasons against also point towards actually many of these hyperscalers, yes, they still have some way to go with regards to their cash flows being spent, but they also have some runway when it comes to debt markets. They have strong balance sheets. Many of them have very positive sort of runways when it comes to borrowing as well at quite cheap rates, bar Oracle on the right-hand side. And also then finally, if we look at many of the largest companies in previous bubbles, and you've got the bubbles listed in the top right alongside the Mag 7, those red bars are the PE valuations looking sort of 2 years forward. Many of those are actually very, very reasonable. Tesla perhaps being the outlier, but the other 6 out of the Mag 7 actually have PE multiples from around 26 down to about 15 times. Very different to many of those other large stocks we saw in previous bubbles. And then finally, whilst many of them have had good returns from the last sort of 6 months and prior, over the last 6 months predominantly, that's been driven by the earnings component. So that's the dark blue rather than the light blue here, which is the multiple. In fact, the multiple has contracted. So these companies have in fact become cheaper as a group. So where can you defend against geopolitics and an AI bubble? Well, we think one of those areas is quality companies such as consumer staples. And obviously quality companies are not only found within consumer staples, but just using consumer staples as an example, you can see that actually in the MSCI world, over the last sort of 30 years, we've had about 31 drawdowns. And the yellow bars are the drawdowns during an up market, the red ones are during sort of a down market. Out of those 31 drawdowns, consumer staples have outperformed on average by about 6.7%. In fact, they've outperformed in about 28 out of the 31 drawdowns. If we then look at the largest drawdown, so those above 10%, we identify about 12 in the last sort of 25 years. And you can see actually the staples have outperformed by about 14%. And in fact, they've outperformed in 11 out of 12 drawdowns. So we think that that's actually a good place to start when you're looking for quality companies, by looking at those companies that over the long term have good persistence in profitability. And those are also companies that have perhaps weathered storms. So that's when we look at our Global Equity Income Fund, that's our starting point. We look at companies that have a persistent profitability, and more specifically, companies that have at least a 10% return on capital over 10 consecutive years. And until 2019, that includes the financial crisis. Now it includes your COVID years. So if a company's profitability fell out in those times, it would not be included in our universe. We focus on value. We don't want to overpay for quality. The entire stock selection process is bottom-up driven. We also look for dividend growers rather than high dividend yield. We think that's a superior way of looking at sustainably growing income streams rather than those that are high dividend yield, but perhaps have a lower total return or are more prone to dividend cuts. And then finally, at Guinness, we run quite unique portfolios where in this fund, we have 35 stocks. It's fully invested and equally weighted. And that's quite unique, but we think that is quite an intelligent way of constructing portfolios, particularly from a risk perspective. Tends to be low turnover, about sort of 4 positions on average per year, a long-term investment horizon. And then very finally, sort of relating this philosophy back, actually quality as a factor. Why should you be looking at it now? Well, on average, it outperforms by about 3%. In fact, last year was the worst year for quality in the last 30 years. And what worked last year was really speculative growth, perhaps an antithesis to quality. So hence why many of these companies are more attractively valued, and hence why we believe you should be looking at quality today. The last point I want to make is just relating back to the fund. One of the key reasons that investors hold this fund and sleep well at night is actually, if you look over the last 10 years, we've had about 13 or about 15 years since 2010, we've had about 13 drawdowns in the MSCI world. And each time is different. And you've got the same reasons on the left-hand side, from taper tantrums, oil, China, COVID, tech, interest rates, tariffs. And finally, if you look at the numbers in green on the right, the fund has outperformed in every single drawdown, proving testament that actually the philosophy and the practice is aligning. And actually, it's a fund that if you're invested in the long term, your capital is being protected, whilst also you're participating in upside as well. Thank you, Ashrina. I'll take it back to you. Appreciate the time.
Thank you very much, Sagar. I have to apologize. We are running a bit over time, so I'll aim to wrap up at 10:55. I'm sure Eugene will make time for tea as well. I suppose, gents, we can't talk about global equities these days without touching on AI. So let's get our AI question out of the way. There was a very interesting question from the audience around the IPOs. So SpaceX, OpenAI, Anthropic are potentially coming to market, and this could be one of the biggest tests of investor appetite for AI. As quality investors, do you think public markets are ready to absorb that scale? And will it be supported by long-term capital or more tactical flows? Santuri, can I bring you in on this question, please, and get your perspective?
Yeah, it's a good question. And at Sifte Fund, we are a little bit worried about this AI hype and also these new IPOs. And we think that the index will be quite concentrated, as the Sagar already mentioned and showed. So a brief answer that I think the index is a little bit more too much concentrated, and also the quality is not there. There's more expectations than the real outcome.
Thank you. Sagar, your approach leans very much heavily on resilience, durability. How do you balance that with the need to capture new sources of growth in a rapidly changing global economy?
So I think that what we look for, as you correctly mentioned, is robust companies. And we have quite a strict definition when it comes to quality, because there's not a one definition across the board. And so quality means slightly different things to everybody. But for us, as I mentioned, it's being persistently profitable in a very simple format. And we add sort of numbers to that. But that persistent element is quite important. So often when you have these sort of AI or new IPOs, and they sort of come with a little bit of a hype cycle, and perhaps they do very, very well over the short term. But actually, if you're looking for very long-term investment, really what you want is quality compounders. Those companies that can compound their earnings year on year on year on year. And actually, it's been proven that those companies over the long term actually have, in fact, better returns than the speculative growth names that perhaps make the headlines. So hence why we're even talking about them. But actually, for a long-term investor, you're trying to time the market when entry and exit, which is obviously very, very difficult to do unless you have a glass ball. And you're also trying to almost encourage herd behavior. And that's been happening more and more so with perhaps the retail investment side. And that's also what's fueling many of the sort of hype with these IPOs.
Thank you, Sagar. Santuri or Alex, I'd like to bring you in on this. So your portfolio has a meaningful exposure to technology, and your framework is anchored on 5-year earnings visibility. How do you balance forecastability and opportunity, and where do you draw the line?
Alex, would you take this one?
Thank you. Yeah, it's obviously a very hard thing to do, and I think that's where the team-based decision-making process that we have is very good, because I will have my views, Santre will have his other views, Olli and Carl not in this meeting, they will have their own views, and we have the investment committee as well. So really we are challenging each other on these key assumptions. Is there more opportunity or more risk? And really trying to narrow down what is the group consensus before making that final decision. And it really comes down to, you have to understand the companies you invest into very well. What is the opportunity set? What are the potential risk factors for the next 5 to 10 years? And combine that with the valuation. So it's not an easy task to do. We don't always get it right, but we try our best. And on average, I think if you make decisions as a group, you tend to be slightly better than if you're just a star manager alone.
Yeah, thank you. I would like to touch on portfolio constructions. There are clear similarities in your approaches, both quality investing, focused on resilience and all of that, but there are also important differences. So there is a question from the audience around turnover rate. You both have a low annual turnover rate of around 10%. Do you find that with technological innovation now, companies' fundamentals could be changing faster, hence likely to reduce your holding period and increase your turnover rate? Sagar, would you like to lean in on this one?
We actually find that because we take a quality first approach, that's one of the factors or styles where we see very little turnover. So if I give you an example, we use a 10/10 criteria. So a company must have at least a 10% return on capital over 10 consecutive years. So it's and economic cycles don't tend to last 10 years. Only 2 have in the last 170 years. And the weighted average cost of capital, if we're getting technical, is about 6 to 8%. So there's a margin of safety. But the point I wanted to make that if a company qualifies in that criteria, it's a 95% hurdle rate, right? So we look at sort of about 16,000 companies down to about 600. But if a company qualifies, we find that there's a 93% chance it will still qualify in 1 year, and 80% chance it will still qualify in 3 years. So actually the turnover from a quality perspective is quite low. The companies that are falling out will have fallen out previously in COVID, in the financial crisis, when competitive forces have taken place, when interest rates perhaps have risen. So we find that as a factor is actually quite resilient, and that contributes to the low turnover.
Thank you, Sagar.
May I, Ashwina?
Sure, yes, you would like to contribute. Go ahead.
Yeah, just a small note on that. AI, nobody knows the impact of AI on the business fundamentals for the next 5 years. And this creates uncertainty, of course. And now we've been reducing our position for example, in semiconductors, because it's more difficult to see what will happen in the next 3 to 5 years, even though return on invested capital earnings are they're excellent today and maybe next year. But we want to reallocate money to more stable companies, and in our case, industrials have been a good place. So
sure. Thank you, Santuri. Another point of similarity and difference is that you both run high conviction portfolios with 30 to 40 stocks, but you express that conviction very differently. Sagar, you mentioned that equally weighted approach. You do that by wearing this hat from a risk management perspective. But Santuri and Alex, your single stock position can get to as high as 9 to 10%. Which approach do you think better reflects true conviction, and how do you manage risk, Santuri and Alex?
Alex,
so
you take that question.
On risk. I'm about to be a father now in 2 months' time. And I go through my flat and I look at, this cupboard here is very sharp edge, and this rug is a little bit loose, and on here this bookshelf, the very heavy books, they could fall down. So we kind of have the same approach in investing into companies, that we have to try to identify the risk factor for the future. And for us, the biggest risk is that we don't understand the risk or that we haven't identified a potential outcome for the future. So it really comes down to you have to know these companies really well, and really once you have a strong idea about the potential future risk and your colleagues have been able to contribute to that, then we can get the confidence to take a higher conviction than medium weight, for example. So that's how we see it. But of course, there's many ways to skin a cat, and equal weight is probably also a very great approach. I'm not criticizing that.
Thank you, Alex. Just one last question from the audience. Your regional allocation, has that shifted over time, Santeri?
Yeah, we had a smaller position in US a couple of years ago, and now it's almost even with the MSCI index, 65% roughly. But our European exposure has increased, being almost 30% of the assets now. So that's the major shift from to European companies, which are more attractive to our life.
Okay, thank you, Santeri. Thank you, gents. Unfortunately, we've run out of time. While the market backdrop remains very complex, it is clear from this discussion that global equities continue to offer meaningful opportunity as long as we stay focused on quality, resilience, and long-term fundamentals. Thank you to the panelists, and thank you to the audience for all the engagement. Eugene, I'll hand over to you now.
Thank you.
Thank you very much. And I totally agree with the last point you made in terms of the opportunity set that's out there. And with Fundrock in continuing to finding new gems like the Sifter Fund. And just for the audience, again, reminder that if you're looking for the Sifter Fund, you can access it through the Bademont BCI Global Equity Fund. To all our panelists, Santeri, Alex, Sagar, thank you so much. And as Vina, thank you very much. We are going to continue now with Global Equity. And joining us for the session, for our two panelists, all the way live from London, we've got Ben van Leeuwen from Lindsell Train and Shane Delahunt from Capital International. And again, maybe just some perspective for our audience. Capital International was previously known as Martello Asset Management. You've seen Martello on these sessions quite a few times, and they are now called Capital International. Our moderator for the session, we are joined by Luigi Marinas from PPS. Luigi, thank you so much for joining us this morning as well, and I will hand over to you. Thank you.
Thank you very much. I hope I'm coming through loud and clear. Good morning, everyone, and good morning, Ben and Shane as well. Thank you for your time this morning. Listening a little bit earlier, we know that global is the focus for this morning, and we're going to be continuing on those lines as well this morning. The focus now, I know it came up a little bit in the last discussion, but will be particularly around AI. And I think both Ben and Shane have quite interesting topics that we're going to be discussing. But not only the topics in general, how it pertains to their portfolios as well and their way of thinking and how those opportunities get into their portfolios. So we'll be starting with Lindsell Train, and I'll hand over to Ben van Leeuwen. Over to you, Ben.
Well, thanks very much for hosting, and lovely to see everyone. Looking forward to getting stuck into the conversation. As you can see from the title, we're going to have another talk on AI. If you could skip through the next few, that would be fantastic. I propose to do a couple of slides about the history of the firm, a little bit about the investment philosophy, just as a reminder, and then we'll get into the real meat of it. So this is our business today. We were founded in the year 2000, so well over 2 decades of heritage by now. We run 5 strategies. Global is the main. It's about 7 billion in sterling today. And International is the most recently launched strategy. I co-run International, and I'm deputy on Global. So we still maintain exactly the same investment principles as we have since day dot. We think there are a very small number of exceptional companies out there that we would want to invest in. We think a lot of these are consistently undervalued by other investors, and that by holding onto a really small concentrated basket of these names and not being shaken out, acting like true business owners, that is one fairly reliable way to outperform over the truly long term. To us, the marker of a high quality company is this high but crucially sustained return on equity over time. What you see there on the graph is the index in orange and our strategy in blue. And as you can see, there's been a positive spread every single year since inception. And that's despite our very, very low turnover, which is about 5% per annum, implying a 20-year holding period. So in aggregate, what that means is that the companies we thought were good have basically remained very good. And you continue to invest in a strategy that is a higher quality basket than the index for only a modest premium, which we think is a really interesting mispricing. Now, these are some of the areas that we focus on. And if you just focus on the tiny numbers at the bottom, you'll see that about 100 out of 150 names of our universe are in those often categories on the left. But it's only about 200 out of 1,300 for the index for those same names. So that is to say, we are going to look very different from the index over time, but we think these are the areas we should really concentrate on. This is the history of the strategy since 2011. Purchases are in green above the line, sales below. And just as I was saying, turnover has been extraordinarily low. Only 9 names bought, and again, less than 10 sold, excluding takeovers, which does unfortunately happen every so often. But we are really sticking to the principles we preach. And this is the portfolio as it stands today. I'm not going to pause here for that long because I'm now going to get into individual slides and individual companies. But these are the 3 kind of main areas that we bucket our opportunities under: consumer and healthcare franchises, media and software names, and financials and networks. Okay. So on AI, one name that has done particularly well for us in recent years has been Alphabet. And we think this is one of the most elegant ways to benefit from the structural changes we see out there today, because it has this full stack approach, and you're seeing the stack there. And it's very simple, but it basically means that Alphabet participates in a number of different ways that other competitors don't, and they only compete in single layers. So you could invest in NVIDIA and try to decide who wins the hardware battle at the bottom of the stack. We think Alphabet has exposure there via its own proprietary infrastructure assets. You could try to think who has the best research capabilities. You could try and second guess which model is going to win out. Or you could play at the top of the funnel, which is the most contentious, I'd say, at the moment, which is where people see a lot of potential disruption. But again, we think Alphabet has exposure across every single layer, but also incredibly strong assets in every layer. At that distribution layer alone, there you go, 7 products with over 2 billion users each, everything from Android to Gmail to YouTube. It's a phenomenally powerful set of assets. As many other presenters have said, predicting the next few years is tricky, but we think this starting point gives you a really interesting right to win. And that is typically what we like to see across all of our holdings. Next slide, please. On the other side of the agenda, at least this year, we've seen these perceived AI losers. This has been a pretty large bucket, as others have commented. It's been mainly the kind of semiconductor value chain build-out players that have really benefited. But ones that have really lost out, although it gyrates a lot, have been information services companies. These are the companies that own proprietary data and tools and sell them into their end customers. And there's been a lot of perceived disruption. We think it's been pretty indiscriminate, and we're only starting to see some nuance come through even now. And even this last week, we're starting to see some green shoots of that. But we've got 2 names here, RELX and London Stock Exchange Group. RELX sells data sets and tools to highly specialized professions like lawyers and risk professionals and academics. And the key message here is we're just not seeing the actual disruption come through yet at all. If anything, we're seeing an acceleration in growth, and we're seeing moats hopefully get even stronger, even though some people seem to fear the opposite at the moment. And I think the key nuance that will come out in the coming years is that the players that will really win, have really strong relationships with their end customers and have that right to win and that first right to implement these new tools. But they're also going to be the ones that own truly proprietary, non-public, highly privileged, very sensitive data. And we think we see this in both. The other name there on the right-hand side is the London Stock Exchange Group. The name is a bit of a misnomer. It's no longer really a stock exchange first. It's more of a Bloomberg proxy, a publicly traded Bloomberg. And again, this is not commoditized data. And what you are actually seeing is that when you can connect AI tools to the underlying data sets, the growth and the demand for this data is exploding. And short term, there are some question marks on how they go about best monetizing that, but whether or not they will manage to should not, in our view, be up for debate. So this is an area we're very excited about. We've managed to add to at better prices. Both companies have really increased their buybacks, and it seems like a mispricing to us. This is another name that we think will be a clear beneficiary, and it's another name where you don't have to invest in AI directly to get the full benefits, and it's Thermo Fisher. It's a life science tools company. This last week, we've had a number of major announcements from Eli Lilly and a couple of other large pharma companies about some of the new breakthroughs they've had. And we are really excited about the future for healthcare as a result of advancements in AI. And what is very clear is that the number of new drugs being discovered and the number of new trials coming through will increase. However, it doesn't change the fundamental issue we have with pharma, which is that it's very hard to discount back various companies' pipelines and assess who will discover these drugs first and so on. What we are more sure about is that they will have to go through human trials, they will have to be manufactured, they will have to be formally tested, and that's where Thermo Fisher is kind of the toll booth. And we've been in a bit of a bottleneck post-COVID. This is a company that kind of demand exploded for a couple of years. It's then subsided. But we think over the long term, it's a very steady compounder and one we're excited to use to benefit from this new AI world without taking on as much direct risk. Now, I thought I'd just give you a little break from AI and kind of explain that there are other ways to sidestep this question entirely. The whole market doesn't necessarily have to be bifurcated into AI winner or loser. And that was actually the title of a UBS report that basically couldn't decide whether or not London Stock Exchange was an AI winner or loser and kind of changed its mind on a month-by-month basis. And one answer is to look for assets that sit outside of that arena entirely. And one answer is sports. So the text I put there in the middle is from a mission statement by a venture capitalist called Joshua Krishna, who has just set up a new permanent capital holding company, as you can see, called Thrive Eternal, where he wanted to create the longest possible duration assets. And this is a guy that has funded every name on the left-hand side of the screen. So he's done OpenAI, Instagram, SpaceX, Anduril. His exposure to deal flows is incredible. And yet the first asset he's chosen for this new vehicle, a vehicle that he wants to last and be completely reliable many, many years into the future, is not a large LLM player or anything like that. It's the San Francisco Giants, a fairly second-tier baseball team, but a sports team. And we agree with him. We think that these are assets that cannot be replicated by technology and have every reasonable chance of being enhanced by it instead. And so our assets are on the right-hand side of the screen, and these are names we've owned for many, many years. 2 football clubs, the WWE wrestling franchise, and the UFC MMA fighting championship. And I encourage everyone to read the full agenda on Krishna's website. But we agree strongly with the sentiment, and we've been practicing it for many decades already. But great to have him join the fold. This is also a slide to kind of maybe pour a little bit of cold water on the AI narrative and look at some hard numbers. And one way to really look at a good investment and a good loyal fan base is to consider the proclivity to pay. And so what I've done here is chart ChatGPT's user base versus the fan bases for a number of our media holdings as a kind of proxy. And as you can see for ChatGPT, we're roughly around 850 million users today, but only 50 million are actually choosing to pay for this life-changing, life-altering tool, which is a penetration rate in the single digits. And even out to 2030, they're not expecting that figure to tick up massively, which is, I think, raises really interesting questions, especially when you compare it with, let's say, the user base of Spotify. We don't invest in Spotify directly. We invest in Universal Music Group, which is the record label which licenses its content to Spotify, but the Spotify subscriber number is the proxy for the user base. And there you've got a paid penetration rate of around 40%. And then you've got Nintendo as well, 100%. You know, you cannot play a Nintendo game unless you buy a Switch, so it's effectively 100. And that's 156 million units sold of the previous console. And then something like 1.2 billion games were sold on top of that. Again, all sold at full price. There are no freemium models for Nintendo. And same for Disney. It's 100%. There is a nuance that, you know, some percentage of that are ad supported as opposed to full price. But again, it's really interesting, or it is to me, what percentage of people are willing to pay for this? And you've got one tool that can automate your life and help you research and so on, but they can only get 5% of people to do it. But you know, if you really want to listen to Taylor Swift or play with Super Mario or watch Baby Yoda or Grogu, yeah, the penetration rates are meaningfully higher, and we find that very interesting as long-standing media investors. And hopefully, they will still be paying for it many years out. The final thing I just thought I'd point out in the portfolio is that we have seen some mispricings come up during this period. And the market is not oblivious and does not remain oblivious forever. So we've actually had 3 bids for 3 of our holdings, which I've kind of represented by their products. On the left, you've had GameStop bidding for eBay, and that's the eBay website there. We've had Pershing Square Holdings make a bid for Universal Music Group, and we've had multiple bids for Brown-Forman, which owns Jack Daniels. Bids are quite frustrating. Often they're made at the worst possible time, and it's not something we actively condone, although obviously we engage. But it just points out, you know, the market is aware that mispricings have been occurring elsewhere, and yeah, these things do not remain forever. And I think it's a sign of a healthy market that there is some level of price discovery eventually. So we'll keep you updated on all of those, and let's see what else comes out of the woodwork. This is the final slide coming, I think. Yes, which I'm sorry is a bit of a tease, but we're still building 2 new positions. This is just to say, you know, as you saw from the earlier slide, our turnover is very low. It's quite unusual for us to find new holdings that we are excited about, but we have found 2. We're currently building them. We hope to have them at full size soon enough so that we can discuss them. But one is a European information technology company, and the other is a North American financials company. We're very excited by both, and yeah, hopefully by the next time we will speak, we'll be able to run you through the pitch for both. But I think I'll pause there and pass over. Thanks for listening.
Thank you. Thanks, Ben. Quite a sobering view on AI, not just the positives we often hear, but some of the things we need to consider. I particularly liked your slide on Nintendo because some people actually like playing with Luigi and not necessarily Mario. But I'll leave it there. Thanks. We'll come back to questions after we've chatted with Shane as well. Morning, Shane, and thank you for your presentation as well that we're going to see now. About 100 years ago, I think we used to talk about, or people at the time used to talk about man versus machine, and Shane will be talking about man plus machine. So I think that's another interesting take on artificial intelligence as well. So over to you, Shane.
Thank you. Thank you very much, Luigi. So looking back over the last 12 months, it's been a very difficult period for investors. They've had to contend with elevated inflation that's stubbornly high, sector swings, regional swings, increased volatility, and much of that volatility has come from retail investors, day traders. There's been a significant uptick in the use of zero-day options on the S&P and other large major indices. So now over 50% of the daily volume traded on the S&P is on these zero-day contracts. So these time horizons that these investors are allocating to have shrunk from multiple years to hours and days, which has increased volatility, particularly around, say, earnings releases, news releases, and in general, individual stock prices. Markets also at an expensive part of the cycle. We've seen a significant uptick in valuations across the board. It's not just the US, but they are relatively higher than the UK, Europe, and emerging markets. And although the latter are at a lower rate versus the US, they are still in that upward trend. Now, there has been some good earnings over the last couple of quarters. So I think Q1 2026 will mark the 6th consecutive quarter of double-digit earnings growth. So it somewhat warrants some of the market willing to pay these elevated prices for that earnings potential. But it does seem now we're at the point where the stock prices have caught up with fundamentals and overtaken somewhat. And there does seem to be a lot of upfront premium being paid at the moment for future growth that hasn't yet come to fruition. It's also a rather concentrated period. So one of the highest concentration in history. There is some strong earnings growth, as I mentioned, fairly broadly across the different sectors, but there are certainly sectors that are outperforming tech, and in particular semiconductor manufacturers and producers. In the first quarter of 2026, earnings grew 95% year on year. So those handful of companies now have an outsized effect and impact on the wider tech sector. So they now account for over 50% of the earnings growth for the wider tech sector. So if we look and think about this from a passive point of view, if an investor were to buy a S&P 500 ETF, nearly 40% of that entire investment will be made up of just 10 stocks with very little exposure to the remaining 490. So expensive time to invest and a very concentrated time to invest, which makes finding financially sound and attractive companies at a reasonable valuation fairly tricky at present. And that's why it makes sense to really focus on the best stocks within the index. It's a very broad index, over 1,200 companies. Our investment process is very much skewed towards trying to find the best possible companies within the sectors and subsectors that are adding value relative to the wider market. And so we can focus all of our resource and energy on those select few companies that meet our very strict criteria. And every company that's in the fund or on the buy list or in the models goes through this full investment process. KLA is a company we added at the start of 2025. We wanted to increase our technology exposure. And we started from the top, technology sector, into the subsectors, industries, and then finally down to the individual stocks. KLA is a company that makes tools and equipment for the semiconductor manufacturing process. So they ensure optimal yields whilst trying to reduce defects as much as possible. So as the chips become more and more advanced, trying to detect those defects becomes exponentially harder. So the uptake and the build out of AI and data centers has benefited KLA massively. And they benefit from margin accretion, excellent return on equity, as well as significantly adding value versus the wider tech sector. CapEx does seem to be increasing at quite an alarming rate now. So the first quarter of 2026, I think all of the numbers that were reported were above previous company guidance as well as market estimates, and that doesn't seem to be slowing down. CapEx fatigue doesn't seem to be taking effect just yet. So the graph on the left is just CapEx divided by revenue. So you can see that some of the companies, some of the tech names that we own, KLA, Monolithic, and ASML, are able to benefit from this theme without having to over leverage their financial statements to do so. And this is just a rotation within the tech sector. So the technology sector is up circa 20-21% year to date, but there is definitely certain parts of the market that are contributing to this return versus others. So the chart on the left is just semiconductor subsector versus the wider tech sector. On the right is application softwares versus the tech sector again. So definitely a rotation within the tech sector, and further concentration within an already concentrated sector. And this is just a chart showing the tech holdings performance versus the wider sector. So although it is a very concentrated market and sector, there are pockets of opportunity within that sector. The names we've held are, again, they're not as leveraged as some of the other names. They have other end markets that they're benefiting from, most of which benefit as more chips are being made, as the more advanced chips are being made, they benefit regardless of end market, which is what we want. We want good exposure without over leverage to the theme. And this is just historic momentum and changing trend. So this is the energy sector versus the wider market. If we think back to the end of 2021, we were just seeing economies open after COVID. There was travel activity picking up after oil had a historically low trough. As demand picked up, it far outgrew supply. There was a lot of underinvestment during that period, so it did take supply quite a long time to catch up to demand. Prior to 2021, we didn't have too much any exposure at all. And then we gradually began to build positions in BP, Schlumberger, and Exxon throughout 2021 and 2022 to bring us up to benchmark weight and double benchmark weight, which really contributed meaningfully to the fund's performance throughout the year. And then obviously after that time, oil prices normalized, energy stock prices normalized. We did reduce the energy overweight to a benchmark weighting, and then gradually increased it over the last 8 to 10 months. We recently added GTT to the portfolio, but this just goes to show that there are still areas where outperformance can be generated outside of the common themes that are really leading headlines at present. So this is just GTT, Schlumberger, and Exxon versus the wider market. And GTT, so we did want to increase our energy exposure towards the middle of 2025. We wanted a name that wasn't as correlated to the oil price as our existing holdings. And GTT is a name that fit that bill perfectly. They focus on licensing the cryogenic membrane technology for LNG transport and storage. So due to the licensing nature of the business, it's a very asset-light company, meaning they have very impressive margins versus the wider energy sector. So they have consistent, sustained net profit margins of above 50%, excellent return on equity, and very or lower correlation versus the existing holdings within our energy allocation. Thank you, Luigi. That's everything I've got for today.
Perfect. Thank you, Shane. Very interesting. I mean, quite a few stocks that maybe many of us on the call not probably have heard about before. So that's always interesting to hear that they can. Maybe as a first question, and we only have a few minutes for questions, but as a first question to both of you, Shane, you in particular mentioned momentum in your slideshow. And it becomes obviously a bit harder against passive investments when momentum is strong in the market. I mean, us at PPS Investments, we like active management and we kind of try to understand managers. But I'm sure, like ourselves, you also get the question around passive investments, especially around this time in the market. So, what's your response to investors and to clients at times when it kind of seems like it's or the recent past has been good for passive, but how long can that continue, and so forth? Yes.
No, great question. I think in terms of passive, there is much more correlation and more concentration, shall I say, to the same few stocks and sectors. And investing into a passive straight away, you get, say, an S&P 500 ETF, you would be holding close to 40% of the top 10 holdings. So most active managers would have a broader remit, more diversification, and be able to work around and trade around trends they see within the market, which passives may be slower to react to.
Yeah, not much about that. I mean, they are becoming more concentrated. How useful they are as yardsticks is maybe reducing. There's also interesting behavior if you look at the kind of the way that SpaceX is going to be included and the rules that are being tweaked behind that. It's quite interesting to watch. But no, we're quite happy maintaining the ability to be a lot more concentrated and a lot more nimble.
Yeah, and I think maybe the next question to you, Ben. I mean, you obviously quite clearly have quite a concentrated portfolio, make very few changes. What are the big advantages to that for clients? And maybe what do you find difficult as well, kind of having that strategy over the long term?
I think the benefit is you get much clearer analog to the underlying performance of the 20 or so names, and you don't get a diluted version of 50, 80 names. You also reduce your risk counterintuitively because you know the constituents that much better, which is really helpful. I think the difficult part is when, I mean, I've been at the firm now for, let's say, 7 years, and maybe we've bought 5 or 6 names during that time. You can find some pretty amazing companies, but if the stars don't align, then a lot of work can go by the wayside. But that's part of the game. You have to be patient. You have to really wait until these opportunities are so obvious that they kind of knock you over the head with a stick, and then be ready to act aggressively. But I think patience is something, as Shane showed with the short-term contracts, that a lot of the market is not experiencing, and if anything, that makes active ever more interesting in this kind of new era.
Thank you. That makes a lot of sense. And Shane, going back to a little bit of AI and what you said about the passive, and is it kind of helpful as a yardstick? How do you then kind of take position sizing, or how do you do your position sizing if that's not necessarily your yardstick?
Yeah, so we have a 3-tier approach. We have our core holdings, which are made up of the top 30 stocks based by market cap. We have the high conviction bucket, which is typically around 3%. This is the stocks that fit all of our metrics when screening, good margins, consistent margin accretion, top and bottom line growth, good return on equity. So this is where the bulk of the portfolio is really, really kept. And we also have the tactical bucket. So a company that may not fit all of the criteria, so a slightly smaller position of 2%. It gives us a good way to enter the stock, see how it progresses, and then oftentimes they move up to the core high conviction categories. A good example would be GE. When we first looked at the stock, just looking at it in isolation, you saw revenues declining, still a high debt level. But of course, it was going through selling off businesses. They were really focusing on their core assets, reducing their debt load. So it started as a 2% in the tactical bucket and then moved its way up to the high conviction as those fundamentals caught up to the holding.
Thank you. Yeah, quite a lot that goes into kind of deciding on the positions then. Yeah, Ben, on your side, I mean, that was quite an instructive slide that showed the few kind of purchases that you've made and the few sales that you've made. And I know obviously you have to take a buy and wait strategy in effect, but do you change those allocations over time, or is it kind of fairly fixed from the time that you kind of make your initial purchase?
Yeah, we try not to fiddle as much as possible. And I think if you if you had a kind of valuation committee once every 3 days, you know, these things can move around so much, and then you can lose a lot of performance and alpha just through second guessing yourself. So we really do try to allow weightings to move as they will, obviously with some kind of nuances. We are also fairly concentrated. So, you know, Alphabet, we only just bought a couple of years ago, and that's already now a 9-10% position holding. So we allow them to rise, and the top 5 holdings regularly are in that 35 to 40% weighting bracket as well. But yeah, I think you should be in a situation where if you're only investing 20 things, if someone told you that any one name had to suddenly be 5% plus, you know, you wouldn't want to be unhappy about that. There are thousands of companies out there. You're only choosing 20. You want to be pretty happy with all of them, I think.
Yeah, indeed. And then maybe one of the other interesting slides that you had, Shane, was the rotation within the kind of AI space in the technology sector. Can you unpack that in a little bit more detail? Now, we saw the chart one going up and down, but I mean more kind of the fundamentals behind or kind of your thinking around that.
Well, on much of the software side, the fundamental story for the most part, the broader software companies hasn't changed all that much. It's more the perception of future cash flows and how at threat they are with AI. And then on the back of that, at the same time, you've got hardware stocks that have really increased earnings massively. So it's been quite an easy trade for much of the market to switch out of software and into hardware. You are seeing somewhat of a reversal. So certain software companies are doing much better over the short, say 1 or 2 months. So a slight retrieve from the hardware into the software side. But still, a lot of the companies in the software have excellent fundamentals. They're good, solid companies. It's just how much weight is being attached to the future cash flows and how much of those cash flows are at threat.
Yeah, thank you. I see Eugene just put his camera on, so that's probably our cue for last question, and maybe a last question, which I doubt we're going to get an answer to. But Ben, any clues on your question marks? The 2 question marks in your last slide.
Compliance were already very nervous about me even giving you the sector. 2 high quality companies. We've followed them for many years. And honestly, yeah, I can't wait to start talking about them. And I'm going to go and buy some more after this call, I think.
That's perfect timing. Thank you very much, gentlemen. Thank you, Eugene. I think we'll leave it there.
Thanks,
Luigi, Shane, and Ben, thank you very much for interesting conversation. And yes, I think sometimes you do need to hold your breath with some of these quality companies, but we'll see how it plays out. And again, there's some open questions from the audience. We'll get that through to the presenters to get answers as well. Luigi, again, thank you very much for your time. In deep appreciation. Right, we're moving on swiftly over to global property. Joining us now is Greg Rawlins, Chief Executive Officer at Ritway Global, an asset management firm that specializes in global listed property. Good morning, Greg. How are you doing?
Fine, thanks. And you, Eugene, and good morning to all our viewers.
Greg, we kept you waiting there for a little bit. We could see that you really wanted to come in earlier, but now is the time, and it's your time. Thank you so much.
Thank you very much, and thanks again to Fundrock for the invitation. It's really a privilege to be able to address your client base. So Lord Kitchener feels very strongly that you should include REITs. However, he may question why you would want to do that after this precipitous decline in early 2022, during that period of high interest rates and inflation. We believe that the decline was overdone, but markets are markets. However, I think the market has, and we feel very strongly that the market has missed out, that there's almost been a V-shaped recovery. Well, in fact, a V-shaped recovery is quite clear. So much so that around about the latter part of 2024, we came out pretty strongly and started telling investors that it looks quite clear that a recovery is intact, and based on the fundamentals and the earnings growth, we expect this recovery to continue. The result is that the recovery has been so strong. The big question is whether this is sustainable or not. However, to South African investors who come into our universe via the REITway BCR Global Property Feeder Fund, that V-shaped recovery hasn't been as pronounced. And the reason is because of this phenomena, because since when that recovery started at the end of March 2023, the Rand has strengthened considerably relative to the US dollar. So what I've done is superimposed the performance of the REITway Feeder Fund. But before we get to that, this is how it's performed. It's been literally a sideways movement in rands since the March 2023 up until the end of last month, which was last week. But what I'd like to do is draw your attention to the right-hand side here, because the phenomenon is starting to develop. It is only inevitable that if the Rand, if a US dollar-based investment continues to rise, that eventually it starts breaking away from the strictures of a strengthening Rand. And this is the environment and the time where South African investors should be increasing their exposure to REITs, in particular via our feeder fund, where in rands, should you have a rand-denominated portfolio. So taking this further, we for many years have been showing you that global property has outperformed global equities. However, this gap has closed quite considerably, and it's now neck and neck on the back of the growth of course, of the tech sector driven by the AI. The question that you've got to ask yourself is whether this is sustainable, or do you need to create some diversity to improve the risk-adjusted returns of your portfolio. And to this end, we have got a product for you in the form of the REITway BCR Feeder Fund. So let's have a look at how this performance has played out since the 31st of December 2024. And as you can see, global property has given the S&P 500, also a tech-laden index, a good run for its money up until a few weeks ago, when the tech continued to improve its performance. Well, is it performance, or is it the pricing that is creating this position? More specifically, and a date that I'd like you to remember, which I'll address later on the presentation, from the 1st of November 2025 up until the end of last month, which was last week, global property has performed very well relative to the GPR 250 REIT index. However, our REITway BCR, on that same date, our REITway BCR Global Property Feeder Fund, from the 1st of the 11th, has actually started outperforming our old benchmark. We mentioned in past presentations that we have now got a new benchmark, and no, it's not one that is easier to perform, but it helps us in our process, particularly with our allocations. And as you can see, we have been outperforming for this period when we really got to grips with the change, and you can see that our total return of 9% in US dollars versus the old benchmark of 8.91%. And remember, ours is after costs. And just remember, not too many active managers outperform acceptable benchmarks. So I want to address the question of is this recovery sustainable? And to this, I'm using a pretty strong word, that development has collapsed, which is setting up a REIT cycle. Now, I'm here in Cape Town, and we're confronted by oceans of construction cranes all over the greater Cape Town and Western Cape area. Whereas over most countries from the Americas, Europe, Australasia, and the East, construction has literally collapsed, other than, of course, in the data center area. And this is brought on by financing costs surging and bank lending being tightened. And so global development has declined sharply. And historically, this is one of the strongest predictors of REIT performance. And then, of course, we've also got the public versus private valuations. And there's a significant discount between the public and private valuations, public, of course, being the REITs. So the valuation gap is now closing, and a new public versus private arbitrage cycle has begun. Further, the balance sheets are, particularly in the Americas, are stronger than ever, with debt levels ranging between 20 to 25%, with a mean, I beg your pardon, of 30%, with a mean of about 25%. However, I must point out, in the likes of Europe in particular, they're still struggling to reduce their debt levels that range from 30 to 40%. So earnings growth, just remember, REIT cash flows are contracted, and I beg your pardon, and we have visible earnings growth that is already locked in. Going ahead, we have got these sector mega trends driving secular demand, particularly data centers, cell towers, logistics or warehouses or industrial REITs. And then something I should have mentioned, of course, is the healthcare sector, on the back of what is known as a silver tsunami, as the aging population needs a specific type of accommodation and medical care. So the demand is structural, not cyclical, and we can see a long runway of sustained growth, particularly in these mega trends that I had mentioned. So in conclusion, why REITs can keep outperforming, the supply line is actually collapsing. It has collapsed and continues to collapse. Nothing of consequence that is coming through. Rent growth is accelerating in particular sectors that I have mentioned. And of course, there's some recoveries as well to the office sector, for instance, where they've been hit substantially over the COVID area, as well as out of office work. However, because of the lack of construction, they are finding that their rental is growing, and there has been a recovery in the office sector. Balance sheets, I mentioned, are strong. Valuations are still attractive. Many REITs are trading at discounts to net asset value, and of course, a discount to the private market. Then the factor exposure, quality and momentum. I had the privilege of working with a data provider, and it became absolutely clear that quality and momentum are the key factors to driving capital appreciation in the REIT sector, and surprisingly, value has little or no consequence to this position. Quite simply, a REIT can have great value for an extended period of time, and that could be as many as 10 years. It helps nothing in your portfolio construction. Income is high and growing, and we're expecting institutional flows to start returning, particularly on the back of many institutions selling their direct property holdings and moving it into the undervalued REITs. So we are the global REITs are entering an early phase of a new real estate cycle, and historically this phase delivers multi-year outperformance. So in response to Arnie Schwarzenegger, he said he'll be back, whereas Arnie, REITs are back. That is the big difference. And you can see in that performance that we showed in the recovery since the middle of 2023. Finally, again, I just want to point out our REITway Global Fund is performing exceptionally well ever since we have made a cosmetic change to our portfolio construction process, and that we have got a new benchmark, often the cause of concern and suspicion. This is a benchmark that actually outperforms the global property 250 index, which was our old benchmark. So we are actually now outperforming this old benchmark in US dollars, and things are looking good. So to conclude, particularly even though we have this absolute stellar run in the tech sector, we believe that you should be including REITs in your portfolio to improve your risk-adjusted returns. I have got some performance tables, but I'd rather, which I can show you, should you want to, please contact us relative to the S&P 500, and if you had included them in the REITs in your portfolio, please contact me. Thank you.
Greg, thank you very much for that update. There's one question from the audience, but I want to start with the different questions very briefly. And I mean, we spoke about property at many, many conferences, and I agree with you, good diversifier in portfolios. But if you look at where we are currently, with inflation becoming more sticky to various aspects that's been covered to death during this conference already, so anticipated rate cuts are definitely pushing back. We don't know how far back. We'll see, in time will tell. But how is your portfolio positioned to protect distributions from some of these REITs or properties that you hold, and protect it from rising debt refinancing and effective borrowing costs?
Well, we do adjust our allocations across Europe, the US, and Asia, dependent on. However, these decisions are driven primarily by the identification of REITs with superior earnings growth, and these prospects, growth prospects, rather than forecasts on interest rate and bond yield movements. So if we can find a REIT that has got visible and reliable earnings growth that exceeds that particular country's interest rate environment, inflation environment, we are going to create positive growth. And that is the main contributor to our allocation decisions, rather than trying to predict what is happening in those interest rates and, of course, the inflation. For example, Eugene, in Europe, the interest rates remain relatively subdued. The inflation rates looks relatively subdued. However, our underweight position is prepositioned on, we just don't see adequate earnings growth in those REIT sectors. And the same thing applies to Japan. It's quite clear that they are going to be raising interest rates. We are cognizant of that. We are underweight Japan for that reason, to a lesser degree, to the fact that we do not see adequate earnings growth in Japan, for example.
Yeah, central banks are moving at different speeds, and clearly that you are accounting for that in your fund. Very, very last quick question. Unfortunately, we're very much out of time, but I do want to take this question from the audience. In the context of the AI-driven CapEx cycle, which you've also heard a lot about this morning already, how should investors think about the relative opportunity set in global real estate versus infrastructure, particularly given the growing importance of power, data centers, and digital assets?
I think this is a fantastic story, or very parallel. Remember in the great days of gold mining in South Africa, a lot of companies supplying equipment and supplies to the gold mining companies did exceptionally well even when the gold price declined. Similarly, in the AI environment, the data center REITs, the infrastructure REITs like the towers, believe it or not, towers is an integral part of data transfer, and that is unlikely to change for a long time, are all very well positioned to benefit from all this capital expenditure. With regard to the actual power, if you've got access to power, you've got a building, you are in a very good position to provide data center facilities and to users. But taking that further, we've seen a lot of development in supplying your own power. And it's already there's a REIT that is developing its power infrastructure first, based on obviously solar to a smaller degree and gas turbines, but are going to be having their own nuclear power stations. This is in Texas, and no, it's not the power station. It's not Microsoft, I think it is, that wants to draw power from the old 3 Mile Island nuclear power station. This REIT that we're talking about is developing its own power, so infrastructure. So it'll be in a very, very good position to draw hyperscale environments, hyperscale clients to the resultant data center properties that they will develop alongside.
Fascinating indeed, and the opportunity set just continues to grow. Greg, thank you very much for your time this morning. Really appreciate it. And we'll keep conversations open as time progresses. Thank you so much.
My pleasure. Thank you.
Right, we're moving on, and we're back on global equity, and we're joined now by Rob Ollerman from Laurium. And it maybe just to create some context again for our audience, Laurium is the appointed fund manager on the Thornbridge Global Opportunities Fund for some time now, with really good results. Rob, if I look at some of the numbers, but I'm not going to steal your thunder. It's good afternoon, exactly 1 minute past 12. Good afternoon, Rob. How are you doing?
Good afternoon, Eugene. Thanks for having me on. Really nice to chat to you.
Rob, thank you for joining. And I normally tell the audience you bring a wealth of experience, and for those audience members who maybe don't know, without giving away your age, Rob, but it's just to qualify that statement. I mean, you've been coming along in the investment industry for a very, very long time, with a very good reputation. Started in 1994, I think, if I remember right, Alan Gray, and then moved to Coronation. We had a couple of positions abroad as well as in Cape Town, among other things, and now at Laurium, and like I said, appointed to manage the Thornbridge Fund. And again, thank you so much for joining us this morning. Looking forward to your presentation.
Excellent. Thanks very much, Eugene. Nice to be here. The opening slide shows very calm waters in a North Italian lake. Obviously, the forces shaping global markets today, it's not been nearly as calm as this. But hopefully I will, in the course of this discussion, kind of highlight some of the elements that we find still potentially lucrative and fruitful, and some of the traps that we think we're avoiding in the current circumstances. Just very briefly, as Eugene mentioned, I represent Laurium Capital. We are the appointed manager of the Thornbridge Global Opportunities Fund. Very grateful for that opportunity. Our team has been around for sort of 17 years. If I look at our very attractive list of faces and names in our investment team, I'm one of many in the team here. The average investment industry experience of our team is 17 years, as you can see from the top row. And myself, I've been around in the market since 1994, as Eugene mentioned, and doing global equities for about the last 12 years. The fund itself, just very briefly flicking over to the Thornbridge Fund, just to reiterate what Eugene mentioned just now, I mean, as Laurium Capital, we appointed fund manager for the Thornbridge Fund. We've been doing that since November 2022, so coming up for 3.5 years since appointment. And it's a UK open-ended investment company in pounds and dollars, but very grateful to have the feeder structure represented here today into the South African market. We took over the fund, I think we had $60 million from memory in the fund, and in total now it's just shy of 400 million pounds. So it's had strong growth over that time period. It's an unconstrained quality at a reasonable price is our investment philosophy, and hopefully that fund signature will become clear and apparent to you as the investor. I'd say we're moderately concentrated in funds, comparing ourselves to a couple of the other fund managers that have been speaking, 30 to 40 shares in our basket. So that's average size of sort of 2.5% to 3%, 3.5% position and weighting. Reasonably diverse, but still, you know, in the context of a global market, also a high degree of concentration in our best ideas. Fund performance since we took over has been reasonable, 20% compound annual growth over that sort of 3.5 year period since we were appointed. The last couple of years have been tough keeping up with the benchmark. Passive indices have been very tough, as has been highlighted now numerous times. And interestingly now, this year, it's not just the US market which is showing that degree of concentration. You know, we're seeing a remarkable degree of concentration within the emerging market sub-indices as well. We've had some Samsung Electronics, but clearly in that memory space, that Korean chip sector space, just not enough. But, you know, still over the last year, up just shy of 27%. Okay, so that's by way of kind of background to the fund and who we are. The background from a macroeconomic perspective, again, has been quite well covered here, so I'm not going to spend any length of time on it. But I think it's fair to say the kind of financial media focuses a lot on what's happening on this slide. Geopolitical risk, Iranian war. I mean, it's all day, every day, 24/7 in our faces as investors. The kind of Trump presidential administration, their agenda from tariffs and dealing with the Fed and the independence there, tax and fiscal policy, and also foreign policy. These are constant gnawing headlines, you know, eating away at risk appetite for investors. Occasionally, you get opportunities that come out of this. We've seen the US yield curve over a period of time. There was quite a strong steepening bias for a period of time. You know, the short end of interest rates looked reasonably benign for a period. Long end, the term premium was stretching out through both Treasury issuance and also concerns around Fed independence and the dollar itself. The Iranian situation, the Straits of Hormuz and energy prices have flattened out that yield curve slightly. But net, there's still been an ongoing steepening of the yield curve over a period of time, and that's something that actually, you know, has presented opportunities for us. But by and large, what I wanted to speak about was not the macro in this context, the big drivers of macroeconomic performance. I wanted to talk about these sort of specific areas of the global economy. When we think how we want to position our portfolio, we want to position our portfolio in a way that takes advantage of these big forces shaping economic growth, industrial growth. So not in a thematically selected way, but in a thematically researched way. And these are the areas of the market that we find lucrative for our research and have found more buy ideas through focusing on these areas than sell ideas. So on the buy side, it's really been about I guess these 6 areas. On the top left, this is technology shares have been a very strong ongoing thematic opportunity. The rate and pace of innovation in the technology sector is unbelievably strong. And in fact, if anything, I would say what we're seeing in the last 12 months has been an acceleration of some of these trends. It started with migration of data into the cloud, and now we're seeing a complete reshaping of the computer architecture for the globe, for the planet, into data centers, and in fact, possibly one day data centers into orbit. This is not complete pie in the sky. This is something which is certainly an active part of the investment thesis within the likes of SpaceX. So those are very clear ongoing reshaping trends. Significant capex is well known, but there's lots of opportunities to play that, not just the brain of AI, which is NVIDIA, but also we've been invested heavily in a company like Broadcom, which I always say is NVIDIA's forgotten cousin. It's the cardiovascular system that supports the kind of blood flow, the data flow within the network and data center space. But you can extend your coverage into the memory stocks, which have done really well, the chip manufacturers, the wafer fab equipment, test companies and manufacturers. There's lots of very lucrative ideas in this space. In general, we found better opportunities in hardware than in software. The software part of this AI kind of wave is still harder for us to pick winners. We're seeing obviously some IPOs and Anthropic and an OpenAI coming up imminently, but it's still quite tricky for us to fully value the commercial opportunity that's being exploited in these platform companies. So we've been more involved in the sort of hardware side. Another big area and a beneficiary of data center rollout has been the electrification and power grid in the US. This has been something that, again, for us, predated data centers. There's been now a positive inflection in electricity offtake after years of kind of structural decline. There's a renewal cycle within the US electricity grid, funnily enough, in other developed markets as well. And so there's really a positive inflection here, and there's a lot of opportunity, not only in generation of power, but also in densification of the transmission lines, right down through to the curb side. And then on the healthcare side, again, lots of opportunity that we see that's investable, that is, multi-year, in fact, if not decade-long. Interest has obviously been highlighted within the weight loss drugs, the anti-obesity drugs, GLP-1s. But we've really been interested in the oncology drug pipeline, which is continuing to evolve. And in fact, just this weekend, we've had the big annual ASCO conference, American Society of Clinical Oncologists, where the latest new drug discoveries are presented and the trial results of those. So again, we're very involved in that pipeline and exposing our fund and our investors to the longer run commercial opportunities within that. I'll be briefer about the last 3. These are kind of ongoing opportunities for us, the nearshoring of the industrial supply chain, tensions between East and West, issues caused in the supply chain by the pandemic, 5-6 years ago. All of these have created an opportunity for the kind of factory automation and that supply chain to be rebuilt. And we've seen some really good opportunities, and in fact, I would say decade-long opportunities for us in this reindustrialization space. The financial sector, I mentioned the yield curve shape. That's definitely provided us with some opportunities. And I would say, by and large, post the financial crisis of 2007, and yes, I can remember that vividly and not fondly. The risk committee has been sitting in charge of banks. And finally, now we've seen the profit committee back in charge. In some senses, I'm being slightly glib here, but while there are lots of financial risks out there, in general, I think bank regulation is poised to provide a bit more of a boost to profitability of the banking sector. And we've been able to take advantage of that over certainly the last 18 months. And then the geopolitical risk premium, if anything, has caused us to temper our enthusiasm in some of these areas, is having to be quite mindful of risks. And we've incorporated into our fund a quality fund, yes, but also one that balances some of the risks inherent in the global picture by incorporating some energy shares and also metals and precious metal shares from time to time. And that's this geopolitical risk premium, which is provided both a hedging opportunity, but also a money-making opportunity to us. Where have we shied away? So where are the headwinds rather than the tailwinds? I would say this slide really captures most of those. Well, I've mentioned the geopolitical risks on the previous slide. But I think many quality managers have been thrown in the basket of consumer first investment propositions. We found lots of quality businesses, strong financial health, compounding returns, high or growing returns on capital in that area that I mentioned previously. But on the consumer side, there's also some high quality businesses, but we've shied away typically through, I would say, these three forces. Certainly on the cyclical area, both affordability, post the inflation surge that we saw in 2022, I think has been quite stretched in general. Prices were, pushed through quite significantly in 2022, 2023, and it's still a fading force here. Confidence has been, relatively weighed on through geopolitical risk and other aspects. And then really important, there's these sort of structural aspects of lifestyle moderation, a push towards health consciousness, and kind of avoidance of ultra-processed food and alcohol and excess in general. I think that those are all ongoing structural factors. And then perhaps as equally important is this channel shift, where previously, if you were focused on a fast-moving consumer good, you were quite happily, marketing that at the end of an aisle in the supermarket. These days, e-commerce and direct-to-consumer marketing has completely changed brand management and advertising. Meta now 20% of the global ad budget. That's been a really interesting counter, and we've seen competition to many of these consumer products emerge from this channel shift. And then obviously a lot of regulatory volatility, tariff policies have created a lot of disruption, and then even things like chip restrictions. So yeah, very briefly, the fund itself, reasonably concentrated, top 10, and in fact, top 20. Reasonably exposed to the US in a geographic domicile of listing. But I would always point out, we're looking for global winners. We're looking for businesses that can compound a very strong product or service across borders, across the globe. And so most of the businesses that we invest in are not domestic or geographically constrained. And so I pay much less credence to this geographic exposure than some might from a top-down allocator's perspective. The fund itself, if you remember one slide, it's this one. Top left-hand quadrant, this is our core of the fund. It's a quality compounding 60% plus of the fund. These are businesses that grind out returns for us, where we're not birds on the wire flying in and flying out. More akin to some of the other managers, where we have a very strong, enduring investment thesis, electrification, plugs and leads in network connectivity, some software commercialization winners, some GLP-1 winners over time, and these kind of form the core of the portfolio. But always there's an opportunity for some re-rating. I call them the ugly ducklings, hoping to turn into a swan. Some of them have really swanned off this year. And then the part of the portfolio which balances kind of some of this risk, and that's kind of this macro thematic part of the portfolio. And frankly, here we rent that exposure. We're not bound into these companies. Typically, the companies that we invest in here, I would reckon are best in class, strong financial health, but do carry leverage and limited pricing power. And that's this bottom left-hand quadrant. And then there's always something in the nursery, always something in the special situations bucket. And no, I never show what it is. So that's pretty much my presentation in a nutshell. These kind of structural themes, in our minds, they are decade-long capital allocation shifts that are the tailwinds for economic growth, but should also be the tailwinds for portfolio returns. We still back active management. It's been really tough, but we think we apply an intellectual rigor to our process, and we want to be better than the average, and that's still our goal. A little bit of macro awareness does kind of amplify our stock selection with continuous risk management, but then always remembering that if you're going to buy the Thornbridge fund, you're going to get this quality compounding core of the fund, 60% part of the fund, which will give you a strong, enduring, ongoing growth. And frankly, we have done really well through these periods of volatility that you have seen with big news flow events, Liberation Day last year, and then also coming back to the Iranian invasion at the beginning of end of February, beginning of March this year. So that's pretty much the philosophy behind the fund.
Rob, thank you very much. Insightful indeed. And I think the previous slide that you showed answered a lot of my questions. And personal perspective, I mean, it's refreshing to see that a quality manager isn't totally oblivious to macro, because we often here, we just look through the cycle. So thank you very much for that. A bit of a naughty question that one of our audience members raised in an earlier panel with quality managers. And I thought, I'll ask it in any event. Maybe you are in a good position to answer that. And, reiterating, you're looking at quality at a reasonable price. Very important that. But is the time for quality almost coming to an end, where quality outperformed for more than a decade, about 13 years? And are we moving into a more cyclical, value-orientated cycle?
It's a very valid observation and question, this degree of outperformance, and you would have thought that there'd be some over time mean reversion of style in the market, etc. I find it just really difficult to answer, because my personal investment philosophy has evolved from quite a value-orientated philosophy to, on the global side, a greater appreciation for quality. And my comeback to you in general, and even to investors out there that are thinking about this, is that when you get high degrees of volatility in markets, in general, the companies that are best placed, what are we investing in? We're investing in companies. We're investing in the profit stream of companies. And the most enduring companies, the ones with the best profit streams, are typically the highest quality businesses. Strong financial health from a balance sheet and risk perspective, decent slug of margins and returns as a starting point, some element of pricing power, and enduring product or service. And so that's a subset of businesses that I want to be invested in for my own money. There will be times when that kind of doesn't work as well, maybe when you get periods of excessive downside in value shares, and then you'll get a bounce. But it's not something that I feel is more transient. It's wanting to be a bird on the wire, on and off, trying to play a mean reversion at a point in time. And I find, particularly for many of our personal investors that we have in our funds, they appreciate more that sort of more long-term thinking about the businesses that we invest in, thinking of themselves as co-investors with those companies.
Rob, thank you very much. I'm going to pause it there. It's been really refreshing to see your views and perspective and how you manage this fund, particularly given your background, where you came from, exactly what you said now, and where the appreciation sits for finding these kind of opportunities in creating wealth for investors. Definitely a fund with a lot of different holdings to what we normally used to. There are some open questions again from the audience. Tian, I'm so sorry, I am going to move on. We will send that through to Rob as well, and maybe Rob can respond to you via email or just get that through to you. Rob, again, big pleasure to have you on these sessions, and thank you so much for your time.
Thanks very much. Enjoy.
Right, we're moving along swiftly, and now we are going to cover global bonds. Definitely an asset class that's getting more and more attention especially over the past 12 to 6 months, not only from a hedging perspective, but offering really good, attractive yields. And now we're joined by Carl Roberts from Colchester, all the way from London. Carl, thank you so much for joining us this afternoon. Well, just morning, I think, your side. Thank you so much.
Still, yeah. Thank you.
Thanks, Carl.
Thanks for the intro, Eugene. Indeed, I am sitting here in London. Who are we as a firm? Very briefly, Colchester Global Investors are a singular focus sovereign bond and currency firm, founded here in London in 1999, but we now have 8 offices around the world. We adhere to a very disciplined value style investment process in government bonds and currencies. And we believe that focusing only on sovereign bonds with our disciplined approach preserves the defensive characteristics that investors expect by investing in global government bonds. And lastly, we manage $31 billion across global bonds, emerging and indeed frontier markets. And I think the final thing to point out, we at Colchester are majority owned by our employees. So why government bonds? I think it's over time they've shown that during risk-off periods, where, for example, an investor's allocation to equities might sell off and suffer, government bonds tend to be lowly correlated and therefore provide a defensive hedge against risk assets which do suffer in that time. And it's for that reason as well that we don't invest in any corporate credit, whilst there might be attractive opportunities there and higher yields. Clearly, in times of market stress, corporate credit tends to act similarly to equities, so you lose that underlying low correlation and defensiveness that one would expect from holding a global bond portfolio. And just to illustrate that point, here we've gone back over the last 20 years and picked out a few different crisis periods. And you can see we've just used the S&P as a simple sort of barometer for risky asset returns, which are the gray bars. The light blue bars are our fund returns during those periods. So hopefully you would want to see those be positive, and for the most part, that's what we have achieved. And then obviously what's relevant to our South African clients are those returns translated into Rand for our Rand share class. And those are the green bars, sorry. And again, obviously the Rand tends to amplify those returns, but it does clearly come in helpful during these risk-off periods when your equity allocation might suffer. And this really illustrates why we stick to our process, which I'm about to outline, and just maintain that allocation to government bonds and currencies. Right, so how do we do it? We consider ourselves a value manager in the sovereign fixed income space. Not a term, I guess, that is often said in fixed income. And sort of what do we mean by that? I guess philosophically, on the equity side, if you have an equity value manager, essentially they're trying to find cheap, undervalued stocks, buy them, hold them for the long term, and see that value realized. We take that same philosophy and apply it to government bond and currency markets. Now, obviously, when you buy a government bond in its local currency, effectively you're dealing with two assets, one being the bond or duration, the other the currency. So we split off each of those sort of sub-assets and value them separately and independently. On the bond side, the primary valuation metric is the real yield. Now, most of everyone listening in will know what a real yield is. For us, the way we think about it is that it's today's nominal yield in any particular country, let's say the 10-year, minus our 18 to 24-month forecast of inflation. And I'll come on to how we do that in a minute. But if you take that approach across a global universe and deduct from each country's nominal yield our inflation forecast for that country, you get a nice ranking from highest down to lowest real yielding markets. Now, we don't stop there. In addition to that inflation adjustment to a nominal yield, we will adjust the real yields for effectively financial soundness. So what we call a financial stability score, whereby we're researching the balance sheet, looking at things like debt to GDP, primary balance, all those kind of balance sheet type metrics that one would consider for a country. But we also incorporate environmental, social, and governance considerations. Certainly, since we're looking at governments, as we like to say, governance is certainly most important. But we also want to factor in social aspects, things like access to clean water, health, longevity, education, these kinds of things. And on the environmental side, what we're looking for are things like resilience to climate change, or indeed natural disasters that countries might face on an ongoing basis. Because we're investing for the medium to longer term, we want to identify risks that emanate out of the ESG framework and how they might impact the balance sheet going forward. And that's really the way we think about it. On the currency side, the primary valuation metric is the real exchange rate, or I guess more accurately, relative purchasing power parity. So that is taking an exchange rate against the dollar, adjusting for inflation differentials over time. We assess where we believe that fair value is of that real exchange rate, and we monitor deviations from that fair value over time. And again, if you do that to a universe of currencies, you get a ranking from most undervalued to most overvalued currencies. Again, we will adjust that deviation for our financial stability score, so our balance sheet research. Although on the currency side, what we're more focused on are things like the trade balance, the current account, FX reserves, those external balance sheet factors. The additional step that we take on the currency side is that we also factor in short-term real rate differentials, or in other words, real carry, as that's a driver of currency returns over the medium term. So essentially, what we come out with is whereby we're building an optimal bond portfolio, so based on those real yields, and we're building an optimal currency portfolio, favoring those currencies that are most undervalued. So really, by separating the valuations of bonds and currencies, it means that when it comes time to portfolio construction, we could like a country's bond market, but think its currency is overvalued. And that's fine. We will buy the bonds and we will hedge out all the currency, or vice versa. Currency is undervalued, bonds are expensive. We can buy the currency using FX forwards and don't have to purchase the bonds. So that's the kind of 10,000-foot view of our investment process. Very quickly on our investment universe for our global bond fund. Obviously, we have the sort of classic markets, sort of G3 or wider G10 markets there. For example, the US, Eurozone, certainly Japan. Fair degree of correlation there between, for example, the US and the Eurozone. maybe 0.7, 0.8 over time. We also include this group of smaller developed markets, New Zealand, Australia, even the UK, whereby those markets have slightly less correlation to kind of, say, treasuries. Now you're talking maybe 0.6 type correlations over time. But we also widen out our investment universe and include this group of non-classic markets, effectively emerging markets, but they must have an investment grade rating. So again, coming back to that defensiveness and liquidity, when constructing our portfolios, we want to make sure that we're reflective of such characteristics, and countries having an investment grade rating, certainly one factor amongst those. But by incorporating this group of non-classic markets, all of a sudden you're including markets that have a correlation to treasuries as the kind of global standard safe haven of 0.3, sometimes 0.2. So very low correlations. So therefore, by having an opportunity set which has low cross correlations amongst it, you can really build a truly diversified portfolio, which will, as we've seen on the previous slides, act in a defensive nature during those risk-off times. We aim to generate 2/3 of our alpha from bonds or from being in the right countries, and 1/3 from currency. So we're a bond manager first and foremost, with currency providing additional alpha, as well as clearly additional diversification across the portfolio. Sectors, obviously, as I mentioned, we don't do corporates, so this is not corporate sectors. Rather, for us, there's 2 times we can step outside buying nominal bonds of a country. One would be buying inflation-linked bonds, if there is value there in a particular market. The other would be buying supranational bonds, so bonds issued by institutions like the World Bank or the Africa Development Bank, which will issue across different currencies, and sometimes there can be opportunities there. But historically, that's been a very small proportion of the fund, and indeed at the moment we don't have any of those. Lastly is duration or maturity. So we don't make interest rate forecasts, we're only forecasting inflation. So that means that duration is somewhat a little less relevant to what we do and think about. Obviously, it's a risk factor that we do have to have some consideration for. And when we're building the portfolio, we make sure that we're not deviating too far from the benchmark duration, given that's what clients are allocating to. So for us, that means we can be plus or minus 25% of index duration. Obviously, when we're investing in a country, there's a choice across the curve of where to invest. And indeed, we have a valuation framework for doing that. What that means essentially, though, is if we have a country that has a higher real yield and a steep yield curve, we'll tend to favor bonds in the longer end. Conversely, as we currently face markets with low or negative real yields and sort of flat or even inverted yield curves, will tend to favor bonds more in the front end. And so therefore, our overall aggregate duration is simply where we're positioned across each country's curve there. The last thing I'll mention is that we only use physical cash bonds in our portfolios and currency forwards. We don't use interest rate swaps or options or anything exotic like that. You give us 100 Rand, we'll go off and buy 100 Rand worth of bonds. Just quickly, real yields. So, do they work? I've talked a lot about them, but here we've put together a very simple proof, which hopefully illustrates that point. So the grey line there is the FTSE World Government Bond Index. So that's the standard sovereign bond index that's initially launched under Salomon Brothers, which is hedged into US dollars. So that grey line is only bond market returns back since the index started at the end of '84. Now the blue line is the return stream from holding the top 3 highest real yielding markets rebalanced every month again in dollar hedge terms. So no currency impact there, simply bond market returns of the highest real yielding markets. Now, how did we calculate these real yields? Well, as I mentioned, this backtest is hypothetical, and we calculated these real yields using 1 year known inflation. So if you were standing in December 2024, we were using December 2025's inflation rate to calculate those real yields. So it is hypothetical. It's using perfect foresight. Unfortunately, we don't have perfect foresight, although we do a pretty good job in our inflation forecasts. But really what we're trying to show here is that by favoring higher real yielding markets and effectively having a go at forecasting inflation a bit beyond where the market tends to look, we've used 1 year here to keep it simple. In our work, we find 18 to 24 months the sort of sweet spot. There can be a robust, repeatable alpha to be harvested by favoring higher real yielding government bonds in your portfolio. And I should also add that this backtest was created whereby countries had to have a minimum rating of A-. So we haven't gone down the credit curve here, and picked up carry in sort of junk bonds. Okay, inflation forecasting, that's clearly key to what we do. Our philosophy is grounded in, I guess, old-fashioned monetarism. And that is if a government or central bank prints too much money, you will ultimately generate inflation. However, we supplement that as well by looking at changes in commodity prices, changes in a country's nominal exchange rate, as well as a measure for capacity utilization. So something like the unemployment rate can be a suitable proxy. Probably goes without saying, but we have a modeling framework whereby we're running regressions using different look-back periods, different lags. We might run a single variable. We might run multiple linear regressions using all the factors. Effectively, we're producing one of those fan charts I'm sure most of you have seen over time. And it's my job as one of the members of the investment team, as well as my colleagues on the investment team for the countries that we cover, to come up with those inflation forecasts. And we revise those at most, typically once a quarter. Again, looking at 18 to 24 months, we find that updating things quarterly is sufficient. And it also means that we can look through in a quantitative way some of the noise that can come from temporary changes to a country's currency or commodity prices. Just a quick touch on our financial stability score, so that balance sheet work that we do on countries. I mentioned earlier it was really a kind of an amalgamation of looking at the balance sheet and ESG factors. The weight of those for any particular country really depends on where the risks emanate from. For some countries, they might have a great balance sheet, but score poorly across governance metrics, for example. Clearly, that's a risk that could emanate over the medium term, so we have to take that into consideration. And that score that we come out with augments those valuations. So using a pretty blunt example, let's take Norway, which obviously has a very good balance sheet and very good ESG factors, gets a positive score from us. So to its real yield, it will get a premium added. So overall, it becomes more attractive. Conversely, if we take, let's say, in Italy with sort of high debt levels, to its real yield, it will get a discount. So it gets, penalized, if you like, for having, relatively poor debt characteristics. Doesn't mean we will exclude it necessarily, but it just means that it has to have a higher hurdle, or in other words, a much more attractive valuation to overcome those risks that we've identified to make it into the portfolio. I've spent a lot of time on bonds, but very quickly on currencies. This is just a chart of the euro versus dollar, or the Deutschmark pre the euro, on a real exchange rate basis, over the last 50 years or so. As you can see, it swings about from undervalued to overvalued. Those periods of time can certainly take many years. In our experience, anywhere from sort of 3 to 7. We don't use stop losses. We're a value investor, so stop losses are kind of antithetical to what we do. But the way we do manage risk is that we tend to allocate part of our risk budget to currencies, and we're very mindful of that. The other thing we do is really, it's not about taking one or two bets. Rather, we're building a currency portfolio whereby we're overweight a group of attractively valued currencies, and we're underweight a group of expensive or not so attractive currencies. And that enables us to, over time, hold the positions and see the value to be realized, because no doubt, holding a currency over a several year time horizon, you will see one or two move against you. So it's about managing that risk and making sure we can see the values through. Just briefly, how do we see the world at the moment? These are our valuation charts. So this is each country's 10-year nominal yield, less our 18-month forecast of inflation. So some of the more attractive investment-grade emerging markets are there: Colombia, Mexico, Indonesia. From a G10 perspective, I would highlight the likes of New Zealand, Australia, and the UK. And what's not attractive, the likes of US Treasuries, Japanese government bonds, and even Europe and China. And on the currency side, this is sort of opposite to the previous slide. What currencies are undervalued and attractive? Certainly the yen, the Korean won, Norwegian krona, even the Chinese renminbi. The dollar sits all the way over here. It's zero because it's versus itself. But really what's important is the neighborhood it occupies, and that really is towards those currencies which are indeed very overvalued. And this is how the portfolio lines up. I'm not going to go through everything here, but probably just to highlight, we're underweight the likes of the US, Europe, Japan. I mentioned New Zealand there, where we have a large overweight, as well as some of these non-classic markets on the bond side. And on the currency side, underweight the likes of the dollar and the euro. Certainly very overweight the Japanese yen, certainly the Chinese renminbi, and a few of those other non-classic markets. And I'll leave it there.
Carl, thank you very much for that. You've run through a very detailed presentation in understanding your fund. And it's not just about buying long bonds only. There's so much more things going on in the fund as well. Maybe for our audience, just very briefly, we are going to launch the BCI Colchester Global Bond Fund soon. So it will be available as a feeder fund, but we'll communicate that as soon as that's available. We are very much out of time. I want to take one question very quickly from the audience, and reads, may help us understand why real GDP growth differentials are not used alongside short-term real rate interest differentials when evaluating fair value for currencies.
So part of what we look at when we're assessing fair values is a myriad of factors. I think if you speak to anyone who has looked at and used real exchange rates over time, they will readily admit that assessing where fair value of a real exchange rate is part art, part science, and there are many ways to do it. You can run regressions. You could even look at long-term moving averages. Real GDP actually is one factor that we do use alongside many. So I'm not saying that we don't, but it's not something that we use. Oh, yeah, we can just assess those differences, and that's kind of where fair value is. So yeah, we do incorporate it, but it's one of many.
Good all-rounder fun. Maybe one very, very last question, just as a matter of interest, and it's from the audience as well. I know at the moment, SA is still junk status, but yields on SA bonds are really attractive at the moment. Have you ever in the past looked at places like SA with very attractive real yields?
Absolutely. So South Africa features in our emerging markets local currency debt program.
Okay.
And to your point on attractiveness, indeed, they are very attractive to us, and we do have an overweight there in SAGBs. I myself have looked at emerging markets for 20 years, so yes, South Africa has always been an interesting one.
Really good to hear that. Carl, thank you so much for your time this afternoon. We're very grateful, and we'll keep an eye out for the launching of the feeder fund. Thank you so much.
Wonderful. Thanks, Eugene. Take care.
Right, to our audience, I do apologize. We're a little bit over time, but we save for moving on to our very last session. Also in global equity, very much anticipated feedback from Fundsmith, and we've got no other than Greville Ward online in the waiting room for a while now. Greville, again, apologies for keeping you waiting, and thank you so much for your time.
No problem, Eugene. I'm the last speaker today, which means that most of your audience have either fallen asleep or they've left for lunch already. So you and I can just have a cozy chat. How about that?
They waited for you only.
You're a very good liar, Eugene. Thank you. Okay, well, hello, everybody. Pleasure to be here. The title of my talk today is What Happened to Quality Growth Investing. And if you want to skip the next 12 minutes, and I wouldn't feel ill of you if you did, the answer is it got run over by a freight train of momentum. There is the disclaimer, which nobody's ever read in the history of the world. Here is US stock concentration slide. There's been much talk already today about concentration. There's nothing you don't need to know. Nothing I need to say to make that any more clear. But that is a long-term chart, and so we are in sort of fairly uncharted territory. And if we go on to the next slide, the reason I wanted to bring this up is because I think some people think that the concentration is somewhat dissipating, and it's actually getting worse, not better. So Financial Times wrote an article on the 7th of May a few weeks ago, highlighting that only 5 stocks contributed to half of the rise of the S&P in April, which is interesting. I mean, that's unusual and not terribly healthy, one might think. And I think that since, you know, what's happened is the Mag 7 have sort of morphed into a different grouping, if you like, but still a very small number of stocks is dragging the market up. And whereas in the past, a rising tide had lifted all ships, that's clearly not the case at the moment. If we go on another slide, you'll see that there are a couple of sectors which have done extremely well. This is since the sort of beginning of the Iran war. But there are plenty of sectors which have done poorly. And so again, even though you read on the news wires that the indexes are all up again today, and it makes you feel that everything's doing well, in share price terms, that's not the case. Also, with respect to people like us trying to do quality growth investing, there are a couple of sectors which traditionally investors like us invest in, and we do, notably healthcare and consumer, that have been particularly bad over the last little while. And this is not, in our view, because the underlying companies are doing poorly. And all we do at Fundsmith is try and analyze the underlying companies to make sure that they are growing and compounding a little bit every day. But the problem in these sectors is, in share price terms, is that they're not exciting enough for a world that wants to invest in things that can go up multiples daily, weekly, monthly. And boring old sort of healthcare and consumer stocks don't really fit into that category in the last few months. Okay, let's move on. So this next slide just shows the rise of the passives. Again, other people have spoken about it today. The passive ownership of the market is now, slide is already out of date, it's over 60%. And what that means is that passive funds have essentially become momentum funds, or even active funds, if you like. And as money flows out of active funds into passive funds, clearly those funds have to go out and buy the larger stocks, which creates its own momentum. And as one of the previous speakers mentioned, there's an interesting thing going on with SpaceX, which is about to come to the market with a fairly limited free float. They've sort of, the indexes are keen to put it in, or they want to put it in. which could create a kind of a very interesting market dynamic where, because of the lockups and the limited free float, there just aren't very many shares for people to buy, which could easily cause SpaceX shares to go up a lot. I don't know. I'm not predicting that, but we're in this slightly mad world where a few stocks are leading the indexes up, and those stocks continually being bought by the passive funds, which is again unusual. Okay, let's move on. So the next slide just shows that we've seen something a little bit like this before, in that this is the run up to the dot-com, or the excuse me, this is the dot-com boom running up to the dot-com crash, and the red line is the Nasdaq. The S&P quality is grey, and S&P value is in blue, and everything was going kind of swimmingly well up to that point. And then if you go on to the next slide, please, you'll see what happened thereafter for the next 2 years, where the Nasdaq had a rather more difficult time, and as opposed to the other two. Again, we're not predicting that this is happening, but as a famous man once said, history doesn't repeat itself, but it does rhyme. And so we have seen periods where very concentrated markets, as in one or two sectors, have led everything up, and there's been this race to get into them, and generally doesn't last forever, is I guess the point we're trying to make. Okay, let's move on. So I just wanted to highlight here the hyperscaler capex, just because the scale of it is so unbelievably massive. And two things to say about it. One is, this is obviously creating a lot of the hype in the market, because there are plenty of companies that are making money from the hyperscaler capex. The hyperscalers are essentially mainly spending their own free cash, which is good, although some of them have started to borrow in the market as well for data centers and other things. But the most important thing is that nobody can really quite work out at the moment is, are they going to get a return which is which makes this expenditure worthy and makes it worthwhile? And if they can't, then are they going to slow this down? And that still seems to be an open question. Nobody's quite sure whether or not the hyperscalers can get a satisfactory return from AI that makes the astronomical capital expenditure that they're putting into it worthwhile. That is an open question. If we go on to the next slide, you'll just see what it's doing to their free cash, and it's having a material effect on their free cash in the short term. I'm sure that they would say yes, but when people start paying, large amounts of money for what it is that we're offering, it's all going to come back. But it's not. It's a very significant reduction in the return on capital and on their free cash flow, and so the jury's still out as to whether or not that's going to come back strongly at some stage when they finish spending on the data centers. Okay, let's move on. So here I'm just showing that over the last sort of 100, 200 years, some very important things have happened, have been invented, have changed our lives. But the question is whether or not lots of money was made by lots of people out of these inventions. And maybe the aeroplanes is the most obvious version of Warren Buffett's famous quote that if a capitalist had seen the Wright brothers taking off at Kitty Hawk on their first flight, that he would have shot them down, because no investors really made any money out of airplanes. Or airlines. It's a very difficult sector because it's very capital intensive. There are too many airlines, so there's too much pricing pressure, and they don't make a return above their cost of capital. And so I think just reflecting on all of those kind of inventions, it's not true to say that necessarily the first movers were the ones that made the most money. If you look at the internet and look at America Online and MySpace, they were the first movers, but ultimately they all but disappeared. And so we know that AI is going to change our lives, and we know that there will be companies and or individuals who make lots of money out of it. It's a little bit unclear at the moment as to whether or not we're already witnessing the companies that are going to make the most money out of it, or whether the second generation or third generation that come along and actually use it or sell it in some particular way are the ones that are actually going to make money out of it. So, people like us that say it's difficult to find the winners in AI are not saying that AI is not going to change the world or change our lives, or that money isn't going to be made. We're just saying it's difficult to work out exactly how money is going to be made and by whom and over what period. Okay, let's move on. So I thought I'd just say a couple of words about the SaaSpocalypse, just because the market is indicating that essentially software companies are all but doomed, and that AI will take over everything that they do, and nobody will ever need a software company again. And we have some limited exposure to these companies. But so in small business software and payment providers, are they going to be disrupted such that they won't exist anymore? Well, possibly not, because they are dealing with a lot of client or customer data, which is extremely valuable, but it needs to be treated extremely carefully. And if a cheaper provider just turned up and said, "Hand me all your data and I'll do all your payments," I think the company would be very wary of just handing over all employee bank data for the worries that it might be distributed to somebody else or get lost in the system. There are also, for payroll processing, for example, because we own ADP, there are all very complicated and different tax and HR rules and regulations in each of the American states, and that you need to be very accurate to make sure that you're paying people the right amount and withholding the right amount of tax. It's an area of human endeavor where being usually right is not acceptable. Also below that, I mentioned medical records, tax and accounting. Again, in the idea of medical records, you can't be mostly right. You've got to be exactly right. And also, patient data is extremely it's extremely valuable, and for all sorts of reasons, you can't just hand it out to other people. So the companies that are involved in these areas have built up trust over a very long period of time. We think that it's probably not right to think that they're just going to suddenly be disrupted and hand over all their data to a much cheaper provider using sort of fewer human beings. Let's move on a slide. Just to mention that what we think is more likely is that the AI will enhance what these companies are doing, that they still have this body of trust with their clients. And so they'll use AI to become more efficient and possibly to reduce the number of people who work there. But it seems to us more likely that it'll be an enhancement rather than just a whole-scale closing down of every software company. Okay, let's move on. I just wanted to show that price to sales of the large caps versus mid caps. I mean, clearly, I mentioned the small number of stocks dragging the market up, but there's also been this complete fascination with mega caps and to the detriment of mid caps. Again, this has happened before, as you can see, but it's probably not sustainable. At some stage, the market is going to look for things outside, the top 5 or the Mag 7 as things to invest in for the long term. And at the moment, almost everything has been left behind, particularly sort of small and mid caps. Okay, let's move on. And this is kind of a concerning chart where for the Russell 2000, where companies with negative earnings are continuing to outperform companies with positive earnings. This is a comparatively short-term chart, only a bit over a year. But the green line is companies with negative earnings in share price terms doing better than companies with positive earnings. Do you think that is likely to continue? Is that a sustainable picture? Discuss. Okay, next slide. I was just going to mention that I've showed the slide before, but returns are fairly consistent, both in sectors, generally good sectors, as in sectors that can produce high returns, persist, and bad sectors. So good sectors generally don't become bad sectors generally don't become good sectors. And if we go on another slide, maybe it's slightly easier to see on this chart. Those sectors with high returns, those generally continue over time. Sectors with low returns, particularly things like utilities, you can see on the right-hand side, where government can sort of can cap returns, or that there's too much competition. Sectors with poor returns generally don't become sectors with great returns. And so, for a long-term investor like us looking for quality growth, this sort of gives us hope that if we're fishing in the right pond, even if the share prices are not particularly popular and they're going down, we think that if you're in a sector that generally produces high returns over time, that you will be fine if you're patient enough. Let's move on. I'm nearly done. A couple more slides. This is just to remind people that the world is an ever-changing place. I know it's very easy when you're sitting in the middle of a kind of AI hype market at the moment to think that sort of the big companies are going to be big forever and what they're doing will be extremely important forever. But just looking at the largest 10 companies in the US, things change, and big companies that seem like they have an unassailable position suddenly are not quite so big after all, because something else comes along and it's bigger, or because something competes away their margin. And so I think there's a lot of recency bias in our thinking about investment. We look at the world as it is today and we just project forwards and think, well, it's going to be like this for a long time. And I think that chart is just a way of highlighting the fact that things change. Let's move on. This is this is a very long-term chart, so long-term that you can't really see the dates, but we're just trying to show here that MSCI quality over a long period of time does outperform. So whereas quality growth is having a difficult time at the moment because people are focusing on a very small number of stocks, and because some of the sectors that managers like us invest in have not been doing well over the last couple of years because they're not exciting enough, if you are a patient investor and you want to own your investments for a long time, owning really good companies that are growing and compounding every day, even if they've been getting a little cheaper over the last couple of years, it looks like it is the right thing to do because historically it has been the right thing to do. Let's move on. I think I've got one more slide, maybe. Oh, that's it. Yeah, this is the only Fundsmith slide I'm putting up. But if you look at the free cash flow yield, which is the evaluation measure that we prefer. Firstly, if you look at the S&P 500, when we started the fund in about 2010, the S&P was trading on a free cash flow yield of just over 6, as you can see. And then that has now got down to 2.8. It's actually got down to 2.7. So the S&P index has got a lot more expensive over the last 15 years. It's actually got a lot more expensive over the last 2 years. The Fundsmith Equity Fund has traditionally, although we started a small discount to the S&P, we've traditionally traded at something of a premium in valuation terms, but only because we believe we can show that we own better companies in the market because our returns on capital are nearly twice that of the S&P on average. But as you can see on the chart, the Fundsmith Equity Fund has gone from trading at a premium to the S&P to now a fairly significant discount. In fact, it's widened since we put this chart out. And so the Fundsmith Equity Fund is trading on free cash flow yield of nearly 4 now, and the S&P on about 2.8. So if you look at the lines on the bottom of the chart, you'll see how they've crossed over for the first time for 8 years, but also it's trading at a wider discount. And how do you think that's going to end? We believe that we own really good companies trading now on a discount to the index because the index has been dragged up by a small number of stocks and a tremendous amount of excitement and hype over a new technology. But although it's been painful in the last little while, we still believe that, as one of the previous speakers said, owning a portfolio of high quality companies that are growing and compounding, albeit they are a little cheaper than they were a couple of years ago, if you're a patient investor, it's not a bad place to be. And what's the alternative? The alternative is that you just chase the momentum and try and find the next big thing. And we saw what happened in 2000 when people did that. So that is not what we're about to do. That's it, Eugene. I have nothing else to say.
Very well, thank you so much for that. A couple of questions coming in from the audience, but maybe before I go to the audience questions, during the annual meeting, Terry Smith also touched on it. You showed a slide on it, and this is rise of index funds. We also had a index tracking fund manager earlier today. But as more capital flows blindly follow into index trackers, how does Fundsmith position itself to profit from the resulting mispricings of these high quality stocks?
Yes, it's a good price. Sorry, it's a good question, Eugene, because clearly, as Terry said in the meeting, you want to, if all active managers are actually going to be taken over and passive is going to be 100%, you want to be the last active manager, because if people are investing with absolutely no thought to the quality or the valuation of whatever they're investing in, then clearly there's going to be some dislocation. And there has been already. But I mean, the fact that you can buy some of the companies that we really like, that we think are really good, on substantially higher free cash flow yields or lower PEs than they were trading on sort of 2 years ago, is to us an indication of what's going on. Now, SpaceX, you might get a really interesting real world example of this, where SpaceX, is at 1.75 trillion or whatever it's going to come at, bears no relationship to some sort of valuation metric. I don't think it makes any money. I may be wrong, but I don't think it does. But what's interesting about that is that if they do go into the indexes are going to have to buy it, and it doesn't matter what the valuation is. No, the Vanguard Global Index, fund is not going to say, don't go and buy SpaceX because it's too expensive. They're just going to buy it because they have to buy it because they have to buy it in the index weighting. And so you're right. There is dislocation. We have to be careful because you can't stand in front of a freight train. So you can't just buy things that have got cheaper, which have had some sort of a glitch, because the market's going to take some time to come back to them. So you have to be mindful of the fact that you can't fight the tape forever. But there will be opportunities to buy really good businesses at good valuations, and that should be a huge advantage for us over time.
I tend to believe as well, and it partly answered some of the questions that came in from the audience, from Charles specifically. Let's just look at where we are with global inflation. It is sticking around a little bit longer. Prices went up, and consumer staples are facing awkward times in deciding, do they protect profit margins or do they start to discount prices to keep volumes up in sales? It's a fine balancing act. How does Fundsmith's core consumer holdings show structural signs of weakening in pricing power, if at all?
Well, so the first thing is we own very much less in consumer than when we started the fund. So we used to own sort of a lot of consumer stocks, Reckitt Benckiser and Unilever and Kimberly-Clark and all sorts of things. And we own fewer of them now because certainly the world is tougher. Secondly, it's absolutely right that the consumer is having a difficult time because oil prices have been higher, inflation is staying higher for longer, and interest rates are staying higher for longer, and grocery bills are going up. Now, I would say that the problem in the US for the consumer is that there's a portion of the US population that's really not doing very well at the moment. So there are rich people making money at the top, the middle class is kind of struggling along, but there are people at the bottom who of society, not bottom of society, but bottom of the economic chain, who are really struggling at the moment. And so that is tricky for the consumer companies. The reason people like us own big consumer companies is not really for what's going on in the developed world, though. It's because the growth of the consumer and numbers of consumers is in the developing world. And so the reason we want to own branded consumer goods is because when new consumers are being created in emerging markets, they are reaching, in many cases, for Western branded products. So yes, it is difficult for the consumer, and we do own less consumer now than we used to, but it's not all over for the consumer, because plenty of people still want to buy consumer goods, and new consumers are being made in emerging markets.
I know you always stay away from energy plays, and you've always positioned that very well in your fund. Given what's happening with energy prices and some of these profits that some of the energy companies are making, do you still hold that view? It's not a play. It's not a short-term macro play that you're going to go for.
We do, but only because with both oil or energy, but also with commodities, the price of the shares is to some extent dictated by the underlying commodity price, and we have no ability to predict that. And so we just feel that as a manager, if we're a long-term investor, it's a bit tricky for us to say to investors, look, I'm sorry, but we bought BP because the oil price we thought was going to go up further and it halved. Sorry about that. Nothing we can do about it. So it's just an external factor that we can't assess. And so we choose to stay away from it. It's not to say you can't make money in energy stocks. Clearly you can if you're a trader, but that's not what we do. It's not what we're trying to do.
And as we've seen, it can change on the drop of a dime, depending what we're getting from next tweet from our big friend. Another question from the audience. Has the flow of investor capital impacted your performance?
No, I don't think so is the answer, because the fund got sort of very large, very quickly, and we've always invested in global mega caps, not because we thought, well, we want to have a highly liquid fund, but more because if you're looking for companies that have grown and compounded for the last 30 or 40 years, then they're going to be big companies. So by dint of what we do, our investable universe has always been made up of very large companies and very liquid stocks. So no, inflows, outflows, I don't think that has affected the performance of the fund, no.
Maybe a last point and more observation than anything else, but welcome to comment. I can only imagine that you've had some very tough meetings with investors over the past year and a half, for obvious reasons. I mean, you showed some of the slides as well. But I think that last slide you had up probably speaks volumes. If you look at the overall fund from a valuation point of view,
Yeah.
It's probably as cheap as holdings has been
Yes.
for a while, with
Yeah.
a lot of value that can potentially unlock,
Yes.
depending on how the landscape around you change.
Yes. Well, thank you for saying that. And certainly that's what we believe as well, Eugene. I mean, we're trying to be mindful of the fact that you can't stand in front of the freight train forever. And so, we are making a few portfolio changes in order to just reflect the fact that there are things that people want to be invested in the moment, and some of those things might do very well for the next few years and fit into our quality bucket anyway. So we're not stepping outside our, but it's not really a market for buying deeply discounted things that people haven't looked at for a while, because their attention is somewhere else. And so we're trying to be mindful of that. But we also do believe that we own really great businesses, and I do understand that that's not being reflected currently in their share price or their valuation, but we think that it will be. And we also believe that at some stage the momentum train slows. It sort of has to, because the S&P can't go up 20% a year for the rest of our lifetimes, because the companies are not growing at that rate. So at some stage, maybe the market will reflect the underlying growth of the companies in the index or in the portfolio. And if that happens, then I think we're fairly well positioned. And look, I also believe that people who are invested in our fund probably don't have all their money in our fund. They probably have investments in other things which are exciting and have momentum and are going up. So I think that we've always positioned ourselves as a very sort of conservative place to put money, and there should be a place for that, I think, in most people's portfolio.
I tend to agree with you. I mean, you had it slide up as well on the whole question around capex spending, if that's going to be properly monetized or not. Nobody knows, up in the air. But again, that can change very, very quickly.
Correct.
Greville, I want to thank you for your time. It's always great to have you on these sessions.
Thank you.
And for an update on the Fundsmith Fund. I know a lot of audience members got exposure to your fund. But we'll keep an eye on the fund most definitely. And thank you so much.
Thanks, Eugene. Nice to see you. Thanks, everybody. Bye.
Yeah. All the best. To our audience, thank you very much for being patient with us. But I believe that there's a lot of value add in some of these conversations that maybe went a little bit over time. I truly hope so. Thank you so much for joining us. Looking forward to seeing you tomorrow for the second day of the Fundrock Global Investment Conference. Tomorrow we will unpack global fixed income, multi-asset funds, and then we've got a couple of really interesting hedge fund panels coming up as well. And see you tomorrow at 9 a.m. SA time. Thank you so much.